By the way, euro-dollar currently down 0.3%. That's largely as a result of dollar strength coming through. 107 on euro-dollar. Currently 490 on the 2-year, a screaming buy according to BlackRock in terms of the front end of the yield curve, just up by about 2 basis points. Iron ore 115, gaining again. You can tie it to the China story. Interesting, the equity prices are lower, but iron ore prices are higher on expectations there's going to be more demand for iron ore. Currently up 0.7%. Let's take a look then at futures. 4 straight days of losses for European stocks, and it looks like we could be building up for a 5th straight day of downside. The volumes will come back with US markets, of course, back and reopening after Labor Day. Futures pointing lower by between 0.3 and 0.6%. So let's give it a few seconds and see how things reflecting this Tuesday morning across these markets. Interesting that retail and the data out of the UK again points to the relative resilience of the UK consumer. And Sam Unstead's going to break down the details for us and give us the context on that data and maybe how it parlays into the views from the Bank of England. The FTSE 100, though, taking no respite or at least reprieve from that. Down 0.4%, 7,424. In terms of the FTSE 100. Over in France, the CAC 40 is down by 0.5%. We were hearing from the ECB's chief economist, Philip Lane, as well, saying that he's seeing some signs that in terms of the gauges on inflation, services, for example, starting to moderate. So painting a slightly more optimistic picture, the chief economist of the ECB, Philip Lane, in an interview with an Irish newspaper in terms of his views on inflation. Of course, we continue to look ahead to September the 14th, that decision from the ECB and the divisions amongst the governing council there. The CAC current over in France now down 43 points. Over in Spain, losses of about 0.1%. Let's have a look at how things are shaping out across sectors. Yesterday, yes, the downside. You saw some upside to start the session yesterday. That all faded by the end of the trading day. But basic resources held on to gains, and it's utilities that were at the bottom of the list in terms of your sectors. Today, you're looking at technology down around 0.4%. Basic resources now lower by 0.4, so giving up some of the gains, at least in the initial stages of this open, compared to the gains that they saw yesterday. Energy as a sector down 0.5%. Interesting given the run-up we've seen in oil prices. We continue to focus on LNG and gas, of course, given the dispute that continues in Australia and potential strikes there. You're seeing industrials currently down 0.5, retail down 0.6, slightly heavier losses in construction at 409, a drop there of 1%. Nothing in the green in terms of your major sectors. Utilities losing again, down 0.2%, and autos off by 0.7. So every major sector currently in the red in the session today. Sam Unstead joins us from our Markets Today blog. And I want to get your views then, Sam, the context around the UK retail sales number coming in higher in August, much higher than the number in July. Does it point to kind of that resilience in the consumer? Does it round out a picture of a UK economy that maybe is a little more robust?
I think it definitely rounds out a relatively good summer. So I think consumers have remained quite resilient. There are a couple of things in this report that are almost always there. So one of them is weather. You can almost track these reports and the correlation of these reports with the relative seasonality of British weather very, very closely. And weather was better in August, retail sales went up. The other thing that happened in August was the Lionesses. And that's mentioned in the report that there was a decent rise in food sales and through that and through people getting together around those events. But the other thing actually to note is that in addition to those events, food sales going up is still mostly driven by inflation. It's mostly driven by food sales being expensive. So the next part of the year and going into the rest of the year may not be so strong.
On the UK, there's long been a debate around what the pension funds can do to kind of stimulate activity and pump more money into private and public markets. There's a new line on this. What are we hearing?
So the new line on it is that what is being called for is an increase in the minimum pension, the minimum amount people are putting into their pensions. But from a market's perspective, and you guys were just mentioning ARM and the loss of ARM, if you like, to the London Stock Exchange. One of the things that's been pointed out, and I do stress one of the things because there are a number of things that are mentioned as for the UK IPO market being so weak, is domestic money. That there's not such a good pool of domestic money to go into domestic IPOs in the UK, and this is part of that push to try to improve that ratio.
Okay, well, we'll see if that comes to the fore. Meanwhile, in terms of energy, and we're focused, of course, on what's happening with gas today, but the news that maybe the UK will lift this ban on new onshore wind farms, which to many would strike as completely counterintuitive that you would have a ban on offshore wind farms in this moment of energy crisis, in this moment of the need to transition to cleaner fuel. Yeah,
I think it's an effective ban. So it would be changing planning regulations that would allow more onshore wind farms to be built. But this has been delayed a lot. You know, this was being talked about over a year ago, almost entirely because of politics. You know, and if you like that kind of NIMBYism, you know, this kind of not trying to upset local residents, because you know, onshore wind farms are not necessarily the prettiest thing to look out on in your back garden. But you're right. That
it's better than a forest fire, though.
I would agree with that. Yes, and I think you know, in particular in the UK, you know, building energy security has been a major conversation here for a long time. This is a relatively easy way to do that and to build an industry as well.
Sake, look at our shoreline, the opportunities to build wind farms. Get over the wind farms don't look good narrative. It's bonkers. It's so dated given our demands and our needs for energy. That's an unbiased view. Sam, thank you very much indeed for some of the key things to think about in terms of the UK market. Sam Unstead from our Markets Today blog. Of course, you can get more from Sam and the brilliant team, of course, in terms of Markets Today and the blog. They're on the UK website or by typing TLiveGo onto the terminal. Let's check in on some of the individual stocks on the move with Joe Easton. And Joe, you flagged the grocers, and that was a good call because there's a bit of action.
So this JP Morgan note having a really big impact today on European stocks. All the grocery shares moving lower after JP Morgan says food price deflation is now a real possibility. And as they themselves note, they are the first bank to flag this and do recommend clients sell a number of those stocks. So we said in Stocks to Watch, they cut Tesco after 5 years at overweight. They also have negative views on a hold Carrefour and Geronimo Martins, and those stocks making up all the biggest decliners on the Stock 600 this morning. So we can see how far those comments are being taken. Those shares did, of course, rally a lot, even since the pandemic, since lockdown, then continued benefiting from food price inflation, which they actually managed to pass on to consumers. But JP Morgan calling the end of that trade this morning and having a big impact, as I say. Then we'll flip over and look at a couple of other downgrades. There's lots of ratings changes at the moment, given we are now through the main earnings season and a few months till the next one. Crédit Agricole, as we said, gets a downgrade over at Goldman Sachs. They go sell on the French lender. That is a contrarian view, and their price target is among the lowest on the streets as well. They say the firm is not handing back enough capital to investors compared to the other banks that you could be buying into. The domestic market in France is where the weakness is. Credit Ag's international business does seem to be pretty strong, but the French retail market hits. Meanwhile, BBVA over in Spain, at the bank over in Bilbao, they get downgraded at Morgan Stanley. They go equal weight on that one. There is some concern, of course, around a windfall tax in Spain, as there is in Italy as well. And Campari, the drinks maker, also downgraded over at Morgan Stanley. They say that the margin outlook for the drinks industry is not as strong as it once was, so those coming down as well. In terms of the other more news-focused companies today, there were just two on the radar. So we had Ashtead. We said in Stocks to Watch that trading desks were telling me that that was weak. The UK market is the weakness. They say that that is weighing on the business in terms of it being more of a US-focused company. Around 90% of the company in terms of machinery rentals is in the US, but the UK market declining. That one down 6% in London. Finally, ABN AMRO, they've got an announcement of a new CFO, but I think that the whole market in terms of banks is weaker today, so probably not driving the stock, but a bit of a news there with a new executive coming down, and that one slipping around 1% over in Amsterdam.
Joe Easton from our equities team on some of the individual stocks on the move and some interesting corporate stories teased out there. Thank you, Joe, from our equities team, of course. Let's take a quick look at some of the other events we are following today. At 9 a.m. UK time, we're going to have the ECB's inflation expectations survey. Interesting, given the comments we've been hearing from Philip Lane, the chief economist of the ECB, in terms of his view that maybe inflation is starting to look a little more comfortable. That's as euro area inflation stops slowing, by the way, in August. At 10 a.m. UK time, we're going to have euro area producer prices, again tying in, of course, to the inflation story and arguably an important data point for the ECB. And later this afternoon, we are watching for comments from ECB Executive Board member Isabel Schnabel, see if she aligns with Philip Lane on that view around parts of the inflation complex looking slightly more optimistic, as she's going to be chairing a panel at a legal conference. It's worth noting, by the way, a redhead crossing the terminal, and this from Reuters. China to launch $40 billion state fund to boost the chip industry. It will be the third fund, by the way, if the reporting gets confirmed. They've had two funds already. This fund, according to Reuters, to be focused on chip equipment. So the kind of equipment presumably made by the likes of the Dutch firm ASML in terms of lithography machines. But it's another part, another component in terms of China's attempts to build out its own domestic chip-making sector that frankly has met some challenges with the likes of Tsinghua Unigroup and SMIC. So reports on that will bring you more details throughout the hour, the context as well. Coming up, Goldman Sachs now sees a 15% chance that the US will slide into recession, down from 20% previously, on cooling inflation and a still resilient labour market. We discuss that next. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? This is Bloomberg.
Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
This is Markets Today. We are 13 minutes into the European trading day. You're seeing losses of about 0.6% across the European benchmarks. Some pretty heavy selling over in France. The CAC 40 currently trading at 7,207. That's a drop of 1%. Here in the UK, the FTSE 100 is trading at 7,404. As you can see, a drop of around 0.6%. Let's get some market analysis then and views from Joost van Leenders, Senior Investment Strategist at Van Lanschot Kempen. Joost, thanks for joining us this morning. What is the next catalyst for these markets? Are we giving up the gains prior to August? Are we seeing a more sustained downturn in the cards for these global equity markets?
Yeah, well, we've been concerned about equity markets for a while, right? We've seen strong gains, especially the start of the year. Europe has been flat actually since about March, so not much gain in Europe. But when you look at the European economy, it's really struggling. It's we hardly see any growth. The second quarter was positive due to some temporary factors, but overall growth is pretty weak. And when you look at leading indicators, they're not strong. We still see earnings holding up quite well, but we're concerned about that. So we're cautious, and we think that there may be some weakness ahead indeed.
Would it be as simple as a pause from the European Central Bank to give some uplift to European equities, or do they need more clarity in terms of the macro data and the views pushing into 2024?
Yeah, well, I think generally the expectations are maybe one more hike, or maybe we've seen the final hike already. That could well be. I don't think that would be a big boost to markets, any change there. Probably we've had the final rate hike. We see inflation is still high, but the prospect of it is coming down. The economy is weakening, so they may not hike in this month. And I think it's difficult for them to pause and then re-accelerate in September because of the weakness in the economy. And then we should get a bit more confirmation of inflation falling. This is all widely expected, and given where inflation is, it's very difficult for the ECB to signal any rate cuts. So I don't think that could be a big boost to markets.
Well, on that point, Joost, is there a risk that markets are underestimating a potential revival of inflation towards the end of the year, given the upside that we've seen for oil prices, given concerns about gas flows out of Australia, given that iron ore is about $115 now a ton? There is upside, their pricing pressure now coming through from commodities. Does that feed into a potential revival of inflation by the end of the year?
Yes, could be, but if it's really energy driven, it pushes up headline inflation and not so much core. It slows down the economy. So I think that's a type of inflation which is a bit easier for central banks to tolerate. Maybe less so now because inflation is already high. But I think that would be less of a concern for central banks because, again, this type of inflation slows down the economy and therefore has a sort of structural negative impact on sort of underlying inflation. So I think it's different from what we've seen over the past year, basically. And I would assume that it's easier for central banks to look through. The caveat, again, is that inflation is high. Normally, it's easier for them to look through energy-driven inflation and those temporary spikes. But that's I think, what they would usually do.
And to your point on the weakness around this European economy, Spanish August services PMI falling to 49.3, so in contraction. The forecast had been that services would remain in expansionary territory at 51.5. So it's a sizable miss in terms of services PMI from Spain, and points as well to that move. We know that manufacturing is under pressure. Now it seems services is starting to give up as well across the Eurozone. But we'll wait for more detail to confirm that view. When it comes to euro dollar, currently at 107, just down 0.3%, but that's more on the back of stronger dollar. Joost, when it comes to the US, this call from Goldman that there's now just a 15% chance of a recession in the US, are they right?
We think it's higher. And the reason is that we think that the impact of monetary policy still has to come for a large part. That will slow down the economy. I think where it comes from, there are two factors, I think. One is the resilience of the consumer. We've seen relatively strong consumer spending in the last month. that seems a bit temporary. We've seen consumers dipping into their savings, so that savings rate is very low. Consumer confidence has fallen a little bit. We know that the student debt repayments will resume, so there will be a break on consumption. So that's one thing. The other thing is obviously the labor market. The labor market is slowing very gently, so it looks very nicely like a gliding path into that soft landing. So that could be, I think that's a big factor. But when you look at, again, confidence, but also PMIs, ISMs, new orders, basically new orders components negative in the PMIs and in the ISMs, and actually orders basically zero. So we think there's a bigger chance of recession in the US than that 15%.
Okay, and you're underweight US stocks. What would give you the confidence to turn more constructive on US equities?
Yeah, well, the economic outlook, and basically we would need to see leading indicators improving, and that's again the confidence indicators, but also the leading economic indicator from the Conference Board, the negative yield curve, and basically what you see is that monetary policy tightness is impacting the economy. We see money growth negative. We see bank lending basically slipping to zero. So we would see more confirmation that we've seen the peak of the impact of that monetary policy tightening.
Okay, thank you for joining us this morning. Joos van Leenders with the analysis there, senior investment strategist at Van Lanschot Company, on what he would need to see to turn more constructive. Currently has an underweight view on US stocks. Coming up, Big Tech is bracing for the European Union's biggest ever clampdown on anti-competitive practices. We're going to break down the details and what it means for US Big Tech. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Markets Today, 23 minutes into your European trading session, and we are in a fifth straight day of losses now for European stocks. Now to what's happening in terms of regulation. A really important story. Big tech is bracing for the European Union's biggest ever clampdown on anti-competitive practices, which may provoke a new wave of legal battles between regulators and Silicon Valley. The announcement on which tech platforms are to be targeted under the EU's Digital Markets Act, the DMA, is due by tomorrow. For the details and the implications, let's bring in Bloomberg's EU competition reporter, Sam Salton. Sam, what is the objective then of these new rules?
Well, hello from Brussels this morning. And yes, indeed, we're expecting that list to be published tomorrow. The overarching objective is effectively to stop at source some of those anti-competitive practices that have really been the bane of many European regulators over the past decades. And what will happen actually tomorrow is that the European Commission will publish a list of these platform services to face those rules. But importantly, those rules don't actually come into play until early 2024.
And which platforms, in your take, your understanding, you're very close to all of this, Sam, in terms of the machinations around policy build-out in Brussels, which platforms could appear on the list, and what are they going to have to do?
Well, we can expect a number of sort of everyday digital staples to appear on that list. Of course, it's all still to be confirmed tomorrow, but for example, Apple may find that if some of its services are designated, it will have to allow users to download apps from outside of the App Store. So for iPhone users, for example, you'll suddenly be able to download apps from browsers or from rival app stores themselves. Meta, if it finds its services like the Facebook social network or Instagram, for example, coming under the scope of those rules, it will have to ask users permission before it combines user data between some of those services. And Google will no longer be able to self-preference or favor the results of its own search verticals, for example, travel or shopping, over those of rivals. But of course, that's all still to be defined, and we're really waiting for that final list tomorrow.
Yes, and potentially pretty big changes in terms of how we all use tech in Europe, of course. Sam, are the legal eagles in the US going to be rubbing their hands in glee at the prospect of higher, chunky fees on the back of some legal action? Are they going to resort to the playbook, these big tech giants, of going to the courts and try and push back on all of this?
Well, it's definitely a potential there. We've seen over the past couple of decades big tech platforms take a rather robust stance against some of the decisions of the EU Competition Commissioner, Margrethe Vestager, Google being one, Apple being another one in particular. But any first legal wranglings will actually come not soon, not too long after this week's announcement on the list, and which of those services platforms believe should be on the list and which services some of those big tech players believe shouldn't be on the list. Now, one platform that has been public about its opposition to coming under the scope of the Digital Markets Act has been Microsoft, and it says that Bing shouldn't necessarily be designated under the rules because it is simply too small a competitor to Google in order to face those new restrictions.
Okay, Bloomberg's EU competition reporter, Sam Stolten, thank you for breaking down the details and the implications. Next, we're going to talk about China's real estate developers and whether or not they've avoided some pain, at least for now. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called red wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
This is Markets Today. Happy Tuesday, 30 minutes into the European trading session and the top stories. European stocks fall, investors looking ahead to an ECB inflation survey out later this morning. Asian equities snap a six-day rally after disappointing services data from China adds to concerns over the nation's economic recovery. Country Garden avoids what would have been the Chinese developer's first default, paying coupons on $2 bonds. But the sector continues to run the risk of overextended credit. And Ahold shares are dropping after a downgrade to underweight by JP Morgan. Other major European grocers are also in the red this session. Let's check in on these markets then. Retail, the grocers are certainly weighing on sentiment, but as is, of course, we mentioned the Taixing services data. Just a reminder, the weakness, the sogginess that comes through there and the concerns that continue to percolate through the Chinese economy. All the gains, of course, of any optimism that came through over the weekend were given up at the end of the session yesterday. And you're seeing the European markets set, at least for this stage, just 31 minutes into the trading session, for a fifth straight day of losses. Across the benchmark, losses are 0.6% at 455. The DAX is down at 15,731, a drop of 93 points, or 0.6%. And here in the UK, the FTSE 100 taking no respite from stronger retail data coming through, down 52 points, or a drop of 0.7%. Across your sectors then, let's flip the board. It was basic resources that posted upside yesterday in an otherwise session that led to losses, of course. The picture is different today across these sectors. Tech is down 0.2%. It's not the biggest standout mover. It's retail that stands out for us. Losses of a little over 1%. Construction materials also down 1.2%. And it's personal care, the lead loss maker across these sectors, down 1.7%. And Joe Easton's going to break down the story for us in just the next few seconds. The other sector that stands out for me is consumer products. We mentioned down 1.2%. Banks is also off, currently down 1%. Across your currencies, worth mentioning the upside that's come through for the greenback, up 0.4% across the Bloomberg Dollar Index. The euro is trading at 107, the pound at 125. Let's get to Joe Easton, though, with the grocer story and the deep dive on what is happening across these individual stocks. Joe.
So you mentioned earlier, Tom, some weakness in the French market. That index, the CAC, underperforming today, and a lot of that coming from two stocks. So firstly, as you say, Carrefour, the grocer, among a number of grocery stocks sliding today, given that downbeat commentary from JP Morgan and several ratings changes from the bank as well. And also, Crédit Agricole went sell at Goldman Sachs. Those two stocks weighing on the French market today. The only other stock having a bigger impact is LVMH, which is dropping with that Chinese weakness coming through from overnight as well. Then over in Germany, Commerzbank, we haven't touched on this one, but they've got a downgrade over at Barclays. Barclays goes underweight, saying the ratings boost has now peaked and that will fade due to deposit migration in the German banking market. And that's the weakest stock on the DAX today, dropping almost 5% at the moment. Another stock getting hit here in the UK, Ashtead, we mentioned earlier, the UK weakness is where the market is seeing declines according to traders and analysts. But we've also just seen a headline crossing the terminal saying Ashtead is also, interestingly, citing the Hollywood writers' strike for some of their weakness. Not really sure the link between a writer's strike and machinery rentals. Bit of a head scratcher. I'll have to go away and have a bit of a dig into that one in a moment. In terms of the gainers, not as many to go through at all today. It's much more of a red day, but one firm reporting some strength over in Switzerland is the Wealth Manager Partners Group, rising almost 7%, the best performer in Zurich today, seeing an increase in their assets under management. You'll remember UBS reported some pretty strong wealth management in Switzerland last week as well, so it seems to be a similar picture there. And Lancashire, also in financials, but over in insurance. This is the Lloyd's of London insurer based in the Inside Out building in London. They get an upgrade by Morgan Stanley, who says that that one should perform better than expected given the strong market. Another firm getting an upgrade is Akzo Nobel over at Deutsche Bank. We mentioned earlier, but they say that the new CEO should help turn around the fortunes of the Dulux paint maker. The DIY market looking a little bit weak at the moment, but according to Deutsche Bank, that stock has fallen a little bit too much. And then finally, in terms of the Swedish stocks, we've got Skanska. This firm, a transport supplier, got a big order from the US State Department. They announced that a few moments ago, and that's sending the stock up 2.5%. So a few gainers today, but definitely much more of a red day today, Tom.
Joe Easton from our equities team. And Joe, by the way, I pulled up the Hollywood Reporter. They got a line on the fact that Ashtead Group acquired a movie equipment rental giant back in 2019. So maybe that's the exposure then to the writers' strike, trailers and rigs for cameras, that kind of stuff. So there we go, a bit of detail in terms of how you link Hollywood to Ashtead. Thank you, Joe, from our equities team. Back to the China story now, and of course, property remains front and centre, given what that means in terms of the GDP of China, about 20% plus or minus. Country Garden has averted a default on its dollar debt by paying coupons on 2 bonds within grace periods. Phew, sigh of relief. The Chinese developer is among the most indebted firms in the world when it comes to property. Let's bring in Rebecca Chun-Wilkins in Hong Kong for the detail. So, Rebecca, can they breathe a sigh of relief? What is next for Country Garden? What are you watching?
Well, they certainly can for now. They have rustled up this $22.5 million, which was needed for these 2 missed coupon payments. They have told note holders that they have paid that within the grace period and averted that official default. But hasn't really changed the overall sort of tune and music for Country Garden. The firm still has 4 other bond maturities that it will need to deal with through the end of this year. It has another coupon payment due this month too. That's across various currencies, but altogether totaling nearly $500 million, about $500 million US dollars there that it will need to figure out how it's going to deal with. 22.5 million, quite small in comparison to the rest of its maturity that's just going to take it just through the end of this year. The thing to watch aside from those sort of payments is September. Quite a busy month for payments this month.
How much stress, Rebecca, are we seeing broadly across the property sector, the linkages between Country Garden and the rest of the property sector? And to what extent is this just confined to the private developers rather than the state runs?
Yeah, this is a really critical question. Are we going to see some of that weakness at Country Garden spread through the rest of the sector? And I'll answer that in 2 parts. The first, looking at the private property firms. Now, there are about 16 of the top 50 property developers in China that are private have not yet defaulted on their dollar debt. That's a very small pool indeed. But those 16 firms, including Country Garden, will have to pay about $1.5 billion US in onshore and offshore payments this month. It is the highest maturity war that they faced this year. So look to all of these payments to see if the stress can be averted, not just in Country Garden, but in these other non-defaulters that so far have managed to cling on to that status of avoiding official delinquency. Then look more broadly, the issue is whether or not we're going to see state firms also hit by some of that weakness. Now, we have seen a significant increase in the number of state firms that have declared there's going to be some kind of hit to their profits. For example, those firms that are listed in Hong Kong and listed in China. So we are expecting to see bigger losses, certainly as we go through this year. So far, debt-wise, although there has been a little bit of a repricing of risk around some of those bigger players, they have been sort of relatively okay. The sector's been relatively stable. The issue really is going to be whether or not we see this raft of stimulus measures start to come through. We are very far from the reality at the beginning of this year where Beijing ideally wanted these big state firms to actually consolidate and take over some of these weaker firms. That isn't really realistic at this moment in time. But if they can at least just keep that sort of going concern and continue to have stable property sales and at least kind of see that bottoming out in prices, that will be significant for these big state players.
Yeah, something to watch. And this, of course, is just the debt on bonds. I mean, there are the pre-sales debts that they owe to those who have put money down on some of these apartments. And, of course, the debt that they owe to many of their suppliers, because often they drag out the time frame for filing those invoices and actually paying off their suppliers. Rebecca, thank you very much indeed for the context around what is happening in the real estate markets. A bit of a respite for Country Garden, but it doesn't seem like it's going to last long. Rebecca Ching-Wilkins with all the details on the context out of Hong Kong. Thank you. Coming up, the pandemic upended corporate life, of course, with working from home becoming the norm for many, but governments and companies, well, they remain split over just how far staff should be pushed into returning to the office. We discuss that, what it means for commercial property owners. That is next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Markets Today. 43 minutes into the European trading day. Across the European equities, then you're seeing another day of downside, another day of selling across European stocks by about 0.7%. The pain coming through from the CAC current as well, down a full 1%. You can link that to the downgrade of some of the grocers there. The other thing worth mentioning across these markets is the role of the dollar and the upside coming through for the greenback. The Bloomberg Dollar Index, currently you're seeing gains of 0.4%. And of course, that is pressuring the single currency in the euro and also the pound here in the UK. 125 on the pound, down 0.4%. The euro dollar is currently at 107, down 0.3%. So strength coming through from the Bloomberg Dollar Index, and that, of course, is not unique today. It's been a bit of a trend over the last few days. We'll see how that plays out. We'll get the analysis as well from Venram, from our markets team and our rates team in terms of how you tie that to rates and expectations around the Fed. Worth flagging that yields are up by about 2 to 3 basis points across the US Treasury curve, 490 on the 2-year, 421 on the 10-year. Let's get back to a broader theme now that impacts all of us working in offices or working from home. Most aspects of life have, of course, returned to normal in the emerging post-pandemic era. Moviegoers are flocking to cinemas, tourists are jamming airports for summer travel, and kids are returning to classrooms. But one thing that hasn't returned to normal is the return to the office. It's the topic of today's Big Take with a slightly different angle, particularly bringing the cultural and regional differences. Let's bring in Bloomberg's Irina Ungel, who has the details on this. Irina, how do return to work patterns then differ across countries? Because for me, this is the really interesting content within this new reporting.
Hi, Tom. So indeed, we see very many differences across the world. So the US is lagging Europe and Asia in the return to office push. Only half of Americans are back in the office, and that's compared to over 75% in Europe and in the Asia Pacific region. Now, Asian countries did a better job at managing COVID early on, so workers didn't really get accustomed to working from home, which of course meant it was easier to transition back to office life. In Europe, habits vary widely, and in the US, policymakers largely stay silent and left bosses and employees to kind of navigate changes on their own. Finally, of course, sometimes the company you work for matters more than the country you work in. So Goldman Sachs famously wants staff back in 5 days a week. At Walt Disney, it's 4 days. At Google and Amazon and others like them, it's 3.
It's really interesting, and it's a stark difference. And the chart that we just showed on screen showing that stark difference that you touched on there, of course, between Asian workers or workers in Asia and Europe versus those in the US, less than 50% versus around 75% for those in Asia. Why are some nationalities then happier to go back to the office?
Well, I think it's 2 things. So it's culture and the way cities are built. If you look at China, which has very high rates of office attendance, that's also partly due to its so-called 996 culture, which involves working from 9 a.m. to 9 p.m. 6 days a week. Workers in Europe and Asia are also more concerned about missing out on social connections with coworkers compared to Americans. And finally, it all comes down to your home setup and your commute. For example, in Hong Kong, you have tiny apartments and an efficient public transport system, which gives you fewer reasons to work from home. In European cities, they are more walkable, and even office areas are connected to vibrant communities, whereas in the US, offices are more isolated and dictated by zoning laws.
Yeah, that's interesting. So what does this all mean for commercial real estate, and particularly commercial real estate companies that have a global footprint? It's incredibly challenging and complex.
That's right. So we have McKinsey estimating that pandemic shifts could erase as much as $1.3 trillion of real estate value in big cities around the world by 2030. Now, the value of being present in the office in different cultures is directly linked to property values. So landlords in countries where work from home is more popular are the hardest hit. Office-heavy areas of New York and San Francisco have suffered steeper declines in real estate demand alongside lower rates of office attendance. And that's compared with cities like Paris and Munich or Asian cities with cultures which value being present in the office.
Okay, Bloomberg's Irina Ungel, thank you. We appreciate the detail there coming through from the Big Take. It's really worth a read. We've talked, of course, a lot about return to office, but the cultural regional differences are pretty fascinating, of course, what it means for commercial real estate. In terms of the economic data, the macro data, we had the Spanish services data coming through earlier. We now have Italian August services PMI falling into contraction. So a similar picture to Spain, 49.8 for Italy's August services PMI The forecast had been for 50.4. So the expectations had been that it would hold its head above water and remain in expansionary territory. That is not what's happened. Services in contraction in Italy, services in contraction in Spain. How does this softer data play in to the next decision from the ECB, September the 14th? Are we now clearly or more clearly in a stagflationary environment in the Eurozone? We'll discuss that and more, of course, throughout the hours and get a take from Venram coming up. We're going to break down the key market drivers. Of course, an hour into the European trading, we'll get a view from Venram on our rates team in terms of the US recession risks and, of course, the ECB. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today, 51 minutes into your European trading day. Losses across European stocks for a fifth straight day. The PMI data keeps coming through. We have a red head on the terminal for the month of August. French services PMI coming in at 46. The prelim print had been 46.7, so worse than the preliminary number. And just a reminder that manufacturing softness has now spread to services across the Eurozone, and you had that articulated with the Italian services PMI coming and falling into contraction with 49.8, and a similar picture for Spain as well, coming in below the surveys. Spanish services in contraction, Italian services in contraction, and French services coming in below the prelim number at 46, firmly in contractionary territory. What does this all mean then for markets? What does it all mean for the ECB? Let's bring in Venram from our Markets Live team. Ven, what do you make of the data coming through from the Eurozone? How you think it informs the decision September the 14th from Christine Lagarde and the rest of the ECB?
Morning, Tom. I think already the markets were thinking, were pricing in the ECB to stand pat next week. And I think that the slew of numbers that we are getting on the PMI, the final PMI readings, are far milder than what the initial prints are. So I do think that that is going to skew the ECB towards standing pat next week. I think that risk is growing. And I think we heard from Isabel Schnabel last week that they are confronting a much weaker economic scenario than what policymakers had envisaged in June. So I do think that that kind of skews the hand, ECB's hand, towards a pause next week.
And you're highlighting for us as well the divergence that we're seeing now across these central banks, Ben.
Yeah, absolutely. I mean, if you look at the RBA this morning, they held rates. The Bank of Canada is likely to hold rates when it meets next week, when it meets tomorrow. And we just discussed the ECB. But if you look at the SNB and if you look at the Swedish central banks, those are likely to keep raising rates for different reasons. The SNB, the Swiss National Bank, reckons that inflation is going to be above 2% next year, and its policy rate is below 2%. So they may want to build some buffer ahead of that revival of inflation next year. And if you talk about Sweden, I mean, they are in a situation where the krona has weakened considerably this year, and the central bank has lost quite a bit of sleep over that ailing krona, and therefore there is a risk that they may go higher later this month as well.
Well, that's really fascinating in terms of the divergence from the Swedes and the Swiss, potentially, and particularly given the impetus might be slightly different. As you say, inflation for the Swiss, but maybe concerns about the currency for the Swedes. Talking the currency, the Bloomberg Dollar Index popping again in the session today, Ben, up 0.4%. What do you read into this? What is driving greenback higher?
I think that there's this realization that the ECB is going to perhaps stay on hold. I mean, we just discussed the data, the final PMIs being sharply lower than the initial set of readings. And that is weighing in on currency traders' minds, because that means that if the ECB is going to stay on hold, that means real rates are going to march in favor of, diverge in favor of the dollar, which is pushing up the greenback. So I don't see materially higher prospects for the dollar from here, but I do think that there is going to be some support in the interim as traders work out where exactly is the terminal rate for the US and the ECB.
Yeah, the Bloomberg Dollar Index up about 4% since mid-July. Ven, what do you make of this call from Goldman Sachs? Jan Hatzius, there's just a 15% chance now of a US recession. Does that kind of align with your view?
Well, I think that the chances of a soft landing, we saw last week, yes, the labor market data showed that, jobless rate is ticking higher, which is the direction what Fed is seeking. But we need, the Fed also reckons that to bring the labor market in the US into balance, they need a jobless rate of 4.5%. We are nowhere near that. And what is going to cross that 4.5% jobless rate? I don't think we are going to get incrementally there. We are going to see a sharp and abrupt downturn in the labor market. And is that not going to cause a recession? I think it will. So I think the Fed may have to raise rates until something in the economy snaps. So I don't put too much credence about a soft landing.
Okay, well, we'll see how that view shapes up in the weeks and months ahead. Always smart. Ben Ram from our Markets Live team on the divergence amongst these central banks. Thank you. Euro dollar down 0.4%, and the line crossing from Germany. August services PMI coming in line with the prelim, but a reminder it remains in contractionary territory, 47.3. Services, the sector, that component of the Eurozone economy now comprehensively in contractionary territory. A challenge, of course, for the ECB as it weighs up whether or not to go higher with rates. That is it for Markets Today. You can get more, of course, from the team on the front page of the Bloomberg UK website by typing T-Live Go on the terminal. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
A very good morning. Welcome to The Pulse. I'm Manish Krenny in Dubai. With the conversations that matter coming up on today's program. European stocks are lower. Disappointing data from China renews the concern over the nation's fragile economic recovery. We also bring you the ECB's latest inflation survey in just a moment. China is reportedly set to launch a new state-backed investment fund that aims to raise around $40 billion. It's for the semiconductor industry. Plus, Israel's central bank keeps rates unchanged, breaking with the Fed's decision to tighten policy. We discuss with the bank's governor later this hour. Breaking news for you across the Bloomberg terminal. This is about inflation, and this is the state of play on the European map. It's about confidence. There is a lack of confidence that China has put a floor under the economic situation as the Caixin slides to the lowest since 2023, so the risk of stagflation in Europe rises. But when it comes to Europe, the ECB says three-year consumer expectations rise. And this is not what Philip Lane and his cohorts want to see. Philip Lane talks about a peak, a second-round peak in inflation. The ECB's three-year consumer inflation expectations rose in July. The 1 year comes in at 3.4%, so that's pretty much in line. But on the forward basis in 3 years, 2.4%. The consensus estimate was for 2.3%. You are seeing as services and the composite number from the HCOB come in a little bit lighter. Again, all of this is driving the woes of Europe. The momentum for stagflation is fervent. Let me show you what is happening across the assets. The Aussie is down on the back of the Caixin being the lowest in 2023, despite the latest red headline on stimulus from China for the chip sector. That is not alone. The Aussie is down now 1.3%. It was a hawkish hike from the RBA. Some more tightening may come, but the unsettling of the services data in Australia has indeed irked the Aussie. High beta, high reaction function to poor data. NYMEX is down by 0.25%, despite the fact that Goldman say you're going to have a large deficit going into the second half, or the last quarter, I should say. There's a fragility to the oil market, according to Trafigura, and they are seeing $100 oil call options trade with size. Rates rise ever so slightly after Labor Day, 4.9%. Do you want to gorge on short-dated paper? We will ask our CIO that question. Euro continues lower, again, the lowest since June, as you are seeing this fervent dollar continue. Standard Chartered were with me yesterday saying short the dollar, but the euro is lower on those inflation expectations and actually a paucity of good news from China. Weaker dollar weaker euro, excuse me, stronger dollar. Let's talk about the inflation expectations. Zoe Schweizwes is with me, our Western European economics editor. Good to see you. How are you, Zoe? Talk me through this. 3 years out, we're not that optimistic that Mr. Lane has a different perception of optimism on inflation than the reality out there. Good morning.
Good morning. Yes, those numbers today must have come as a bit of a shock. As you said, the 3-year number, consumer expectations for inflation 3 years out, unexpectedly increased. It was at 2.3, now it's at 2.4, 0.1 percentage point increase isn't something huge, but it's just a move in the wrong direction. And at the same time, the 12-month ahead number, that one failed to slow. So that one's been slowing for 3 months, and now it did not. So overall, those are not the data those people on the Governing Council who think it might be time for a pause will be wanting. And that comes, of course, after last week's actual hard inflation data. This today just is a survey. So consumers can be wrong. Hard data actually tells the story. And as a reminder, last week's inflation data saw underlying inflation slow, but again, the headline number stood pat. Both of those are 5.3. And as we all know, the ECB's inflation target is 2%. So that isn't really good news.
Well, let me give you an old hint, which is if you feel poor, you are poor, you spend less, and you restrain yourself from spending. Well, that's just old-fashioned human nature rather than hard data. Now, the chief economist, Philip Lane, he's in the Irish Times, I think, today, talking about this slowdown in the core inflation. He's fairly confident. What would that mean in terms of the rates narrative, Zoe?
So the ECB, their mandate is headline inflation. Core inflation is, though, the number that, core inflation, that's the number that strips out volatile elements such as energy and food. That one has been continuously slowing, and they have been saying that's the number they care about more, because if underlying isn't calming down, then headline eventually will start increasing again. So the underlying number, him giving an indication they think it will slow, and as a reminder, next week we get new economic forecast, that would be an indication that they want to hold. Overall, though, it's slightly a mixed picture because Lagarde in July said very clearly September will be a hike or a hold, and there are some elements that say a hike actually might be needed. And the more hawkish members of the Governing Council, and the weekend we just had the Belgian central banker Wunsch, they were like, a little more might be needed. And the argument the hawks are making is it's better to hike too much than not enough. Whereas the doves are saying, look at the economy. We need it's about time we stop. And they got backing from, they're getting backing from politicians in that respect as well. Yesterday, Spain's Deputy Prime Minister, Calvino, said it would be a good time for the ECB to stop hiking rates. And the Italians, as we know, have been very vocal saying the ECB has done too much already.
Well, I mean, look, it's a broad church and it's a hard family to satisfy, isn't it? If we talk about growth versus inflation, how is that debate playing out? I mean, I like what Lagarde had to say, which is, you know, she's certainly holding the suspense for us, isn't it? Which is, you know, action over words. But where are we on the growth? I used the word stagflation, Zoe, when I talked about China and the transmission mechanism, the tail risk from China into Europe. Stagflation is a very real and present danger in the European context.
It is, and last week we got the minutes from the ECB July meeting, and those minutes clearly stated that that some governors are worried about stagflation. So the issue here is that the euro area just is basically treading water, that it's not growing, and that means that there is in fact the danger here that numbers will in fact go into another recession. So Germany, as we know, is one of those countries that typically is the engine of Europe, and that's doing very poorly. So the idea here is that if growth is weak enough, that actually will force inflation down. But again, is that something you really want to play roulette with the European economy? Is that something they want to focus on? And what the hawks will all tell you is our mandate is price stability. So if inflation still is more than twice our target, what are we doing about thinking about holding?
Now, Zoe, if you want to talk about playing roulette with the European economy, you only have to go back to the foothills of history for the European debt crisis, to Greece, to the at-dawn moments. I'll leave you with this thought, Zoe. The weekly fear index is at the highest level since October as the downside risks prevail in the euro. Now listen, I'm off. You won't have me for a while, so we'll have another go at your name so that you don't throw darts at the name. It is Zoe Schneeweiss there in our Frankfurt office. I nearly got there, Zoe. Forgive me. On the latest with European data. So China has set to launch a $40 billion state fund. What's the aim? To boost the semiconductor industry. That's according to a Reuters report out just under an hour ago. Will it work? Let's bring in Rebecca Chung Wilkins in Hong Kong. Rebecca, good to see you. Here we go. Another arrow from the quiver of stimulus. How big an arrow is this? Come on.
Well, for the first time, this sort of mode of stimulus, rather than, let's say, the rate cuts and so on that we've seen, actually really also align with Beijing's sort of broader goal here. It's increased emphasis on national security, the desire to push back against all these efforts by the US and allies to de-risk and ultimately to kind of really shore up its own ability in these areas of strategic technology. So we know that in addition to sort of this kind of stimulus via this sort of state fund, there is also quite a lot of support and backing in the private sectors as well, particularly when it comes to this industry in supporting development here. So it's one of those mechanisms that comes with broader market and investor support.
Like Country Garden is the story that has stolen the headlines in perpetuity. You know, we have been one step away from default on a number of moments. We understand there is a payment on some bonds that is going to be made. That is a stay of execution. Is that long-term? Is that enduring? Or is it a temporary reprieve? Your assessment?
Well, look, when you just see at the bond levels, the pricings today, bonds somewhere between 13, 14, 15 cents on the dollar, that says it all really. Even with this avoidance of an official default, investors are not pricing in any particularly high rate of recovery here at all. So they have rustled up this $22.5 million, they say, and they have told note holders, in order to avoid an official default, they've made that payment within the grace period. But Country Garden, even just this year, has to raise another just over $500 million to pay off at least 4 bond maturities and another coupon that comes due this month. So we're certainly not over the sort of will they, won't they excitement that we've seen all through the last 30 days of this grace period.
Well, yeah, it's probably more than excitement, isn't it? It's sort of, you know, fear, loathing, and terror in terms of the tail risk. Rebecca, thank you so much. Rebecca Chung Wilkins in Hong Kong. Coming up, we're going to dive into these markets, get a little bit more on the ECB inflation narrative, on the expectations survey. Grace Peters joins me, the EMEA head of investment strategy at JP Morgan Private Bank on Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Let's recap the breaking news that we've had in the past couple of minutes. Now, a lot of it comes down to the inflation outlook for the Eurozone. And the top line this morning was the Euro area services. First of all, the PMI there falls to 47.9 from a preliminary reading of 48.3. So again, a lagging in the services, and three-year consumer expectations rose in July. And that is the rub of the issue for Philip Lane and Christine Lagarde in terms of where we are. The three-year perspective on rates and expectations of inflation are at 3.4% and in 2.4% in 3 years and 3.4% in 1 year. That's going in the right direction, some people would say, but it's still above target. And Lane describes peak second round moments in inflation with the effects of prior increases now feeding through to the economy. Let's take all of that. A lot of data, a lot of verbiage, but let's see what the Managing Director for EMEA, Head of Investment Strategy, Grace Peters, makes of it. Grace, you know, we can do battle over numbers and where we are, but the trajectory of inflation is on the turn. The trajectory for central bank rates is careering towards the peak. How much more important is it for you and I to consider peak ECB, Fed, and Aussie relative to these inflation prints this morning?
Well, I think what's important about the inflation print this morning is that it speaks to the degree or not to which inflation is anchored when it comes to the Eurozone. We know that the arguments for an ECB pause are certainly growing, particularly with those weak PMI numbers. But what the ECB needs to see is very clear, compelling evidence that inflation is on its way down, with that lagged effect of interest rate hikes that we've already had. And I think that this morning's data, particularly looking out to that three-year number nudging up slightly, is not really what the ECB would have wanted to hear. But we're going to get to a point, 2.3, 2.4 is not so far from the 2% target. And we're going to get a point like they have with US consumer inflation expectations, where we start to trade a bit more range-bound, and perhaps we're there. We do think that we are close to the peak in rates. We think that the Fed is now on pause, and that the ECB has probably got one more rate hike in it. Perhaps they're going to do a little pause, as the Fed did in June on the 14th of September. But one more rate hike, but we're almost there. And we know that when it comes to the pause in rates, that's generally a positive for risk assets. And so our mantra for this year has been weaker growth, stronger markets, as we anticipate the eventual pause across the developed world central banks.
What is the biggest risk? On a daily basis, we're talking about country garden, we're talking about intervention in the China growth story. I'm using words around stagflation in Europe, so is the ECB. When you look at the biggest risk, is it squarely in Europe and China relative to the US, and therefore does that drive the exceptionalism of US equities in your book?
I think that you've got obvious risks around the world, around growth and inflation, and that they are at the moment centered in Europe and China, as you point out, Manus. I think other risks that have really captured the market's attention over the last 3 months
and have ultimately pushed up term premia within bond markets is also government debt, and this notion that something's changed. Something's changed in the construct of the economy. You know, those forward-looking inflation numbers also speak to the idea that the landing point for inflation is structurally higher. And obviously there are knock-on implications when that comes to, you know, as I mentioned, government debt, financing, and therefore across asset classes. So one of the most interesting things that I observe is the relative risk premia between equities and bonds. We've seen over the last 18 months equity risk premia come down, and I think that's reflective of the fact that equities, if inflation's in a 3 to 4% bucket, equities are actually quite a good hedge for inflation, and therefore the risk premia that you're commanding in the equity market has fallen over a period of time, and that's obviously helped support valuations as we think about the year-to-date rally. Now the reverse is true in the bond market. Actually, term premia, the risk premia, what you need to be compensated to own fixed income, has risen, and particularly it's risen over the last 2 months as we look to US debt ceiling discussions, the US debt downgrade, and what is still a risky environment when it comes to that outlook for inflation. So that, to me, when we think about not just sort of risks that we've been talking about for a while, but how that actually gets priced in the market is a very interesting sort of observation.
It's interesting that you talk about the term premium, so that makes it much more appealing. Even myself, I look at it, I mean, I've got a producer here who says that new luggage that you bought will see you out, the new passport that I've got will see me out, and I really should be buying bonds at 4.3% because technically that would see me up over the hill. But here's the thing, bonds are going to deliver the third, well, a caveat, there's a potential that bonds can deliver the third annualized loss, and we haven't seen that in 250 years. The question is there enough term premia in there to justify you allocating more to bond than to equity, or incrementally taking some duration relative to equity? Briefly, Grace.
Yeah, incrementally, we're happy to take a little more duration. I think the most compelling part of the bond market still remains at the front end, looking out sort of to 3 years, where you're not taking extended duration risk, but you are still capitalized, as you say, on those higher yields. We are equity bulls. Our target for the S&P is 4,800, but I think that there is that argument, particularly as you think in the portfolio context, to hedge for weaker growth, that extending duration a little looks increasingly compelling, particularly in the US, where we do think that the Fed is now on pause.
Well, at least we didn't manage to get you to say what BlackRock did, which was 2-year notes are screaming buy, Grace. But your elegance in the definition of duration, you see, that's the difference between J.P. Morgan Private Bank and perhaps BlackRock. The J.P. Morgan Bank EMEA Head of Investment Strategy, Grace Peters, our guest this morning on markets. We got more ahead for you. We digest the inflation data. We ponder on duration, and we look forward to the Israel Central Bank Governor with my co-host from Daybreak Middle East and Africa, Yusuf Gamal Al-Din, in just under 10 minutes.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world and the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
It's the conversations that matter, the insights that you need, right here on The Pulse every day. I'm Menace Crenny, in for Francine Lacroix today. We've had a lot to deal with. The Aussies go for a hawkish hike, and that, to a certain extent, has moved some of the FX markets, which you are looking at here. You're looking now at the pound down 0.75%, the euro off 0.4%. The dollar is rising. You can see all of these equity markets are under pressure. Switzerland and the CAC off 1.2%. So you are just seeing that run into the dollar. You are seeing inflation expectations ramp a little bit higher in Europe, and this is not the way it was supposed to be. The ECB says consumer inflation expectations inched higher in July, and so what you are seeing 3 years out, they rise to 2.4%, so still ahead of that 2% target. But you are seeing money go into the dollar overall. We're in a slightly risk-off narrative. That's what's driving the dollar rather than the euro in that respect. So keep an eye on that. Let's get ready for the conversation with the Bank of Israel Governor Amir Yaron in just a moment on Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
Euro area consumer expectations for inflation 3 years out unexpectedly increase, remaining above the ECB's 2% target. China is reportedly set to launch a new state-backed investment fund that aims to raise $40 billion for its semiconductor industry. Plus, Israel's central bank keeps rates unchanged, breaking with the Fed's decision policy tightening. We'll hear from the bank's governor next. A very good morning. Welcome to the Pulse. I'm Manus Cranny in Dubai. We promised you that exclusive conversation with Israel's central bank, keeping interest rates unchanged, breaking with the Fed's last decision to tighten policy, even as the shekel depreciated to a 3-year low. My Daybreak Middle East and Africa co-host Yusuf Gamal Al-Din joins us now with the central bank governor for Israel. Yusuf.
Thanks, Manus. While they keep their benchmark rates unchanged at 4.75%, I want to discuss some of the policy implications with the governor himself, Amir Yaron, and he joins us now for a closer look at all of these moves. Governor, thank you for making time. It's fantastic to get you back on Bloomberg TV. In terms of the data that we're getting from all around the world, it tells a story of a fight against inflation that is not won yet. We had data out from South Korea, upside surprise there. It's a similar story out of Europe over the last few hours. Talk to me about how a higher import bill is going to make it a lot more difficult for the Bank of Israel to reach its target by the end of this year.
Yusuf, good morning. We believe that the current rate is in a restrictive territory that, barring surprises, and we are all data dependent, and that's why we said there's also a non-trivial chance that we might need to continue to raise rates. But right now, even though inflation is at 3.3%, we believe the next reading it will be at 4%. But even with the current exchange rate, expectations are anchored, and we see a process whereby inflation comes back into the target by Q1 24, and we have above 1% real interest rate. And so we believe in our economy, this should bring us back into the target without damaging the economic activity more that's needed.
So, Governor, the shekel is down about 8% so far against the US dollar in 2023. I look at some of the other currency dynamics, and the question becomes, is this something that you can control with tighter monetary policy, that depreciation, or is this something that's going to be up to the government to address?
Yusuf, this is, let me take a step back. The shekel has had a very tight correlation or relationship with the developments in the financial markets abroad. That link has weakened significantly since the beginning of the year. A lot due to the uncertainty that has been brought about by the judicial changes. And we are seeing the market basically trying to figure out the appropriate risk premium that's associated with that. and we believe the market is the one that should determine that risk premium. So far, although there's been a significant increase in volatility of the shekel, markets have functioned well without any market failure, and that's why we let the markets dictate that. At around the current rate, the market expectation, as I mentioned, are already incorporating that into their transmission into inflation, and nonetheless, we are seeing them saying that we will be back into the target at Q1 24. So I think a lot of it is basically surrounding the issues that I mentioned regarding the uncertainty. And right now, barring market failures or very, very significant changes that would impede on getting inflation into the target, we should let the markets determine them.
I mean, here's the thing. I look at the performance of the greenback, the Bloomberg Dollar Index, now at the highest level since March. And if dollar strength was a headwind so far this year, maybe it's going to be a tailwind for the remainder of the year. Do you think that we have reached peak or are getting closer to peak Fed rates, i.e. peak dollar strength?
I think the Fed is signaling that it's getting closer to the end of its cycle. And as long as markets and the economy there is functioning well, and we don't see any reasons for flight to quality, the gap between the interest rate probably should favor some strengthening if you hold all other things equal. But as I said, right now, some of the traditional correlations that we've seen in the past are masked by some of the uncertainty that is going on internally here in Israel.
There's a lot of speculation as to whether or not you're going to hang around for a second term. I know the Bank of Israel has publicly pushed back on some of that speculation, but I want to ask you very openly, do you actually want to do another term?
Yusuf, as you mentioned, I'm close to the end of my first term, almost 5 years. Perhaps one of the most challenging terms there have been in Israel, 5 election cycles, COVID, Ukraine-Russia war, worldwide inflation, and in Israel, and now a set of judicial reforms that are bringing about a lot of dispute in the social fabric in Israel. And so, this is the background. I've said what I've said to many. I'm going to take the holiday period that's coming here within the next couple of weeks to figure out what are my next steps regarding that.
Yeah, I mean, it's stressful by any stretch of the imagination, so I do relate. But in terms of this structural achievement that Israel had been able to keep for many years, which was a politics-proof economy, is that now coming to an end? And do investors need to be newly sensitive to political risks? Because I look at the notes from global investment banks, Governor, and they're including the term political risk more and more in a lot of their analyses.
Clearly, some of those international banks and the rating agencies are pointing to some of the risks associated with the judicial reforms. I've stated in the past that it's all economic literature points to the importance in order for have economic prosperity and growth that the institutions are strong and independent. And that's why, in spite of the fact that we have and entered 2023 with a very good fiscal stand, debt to GDP that is below 60%, a deficit that's going to be on the order of 1 to 1.5%. On the governance issues, they are monitoring what is going on with respect to these judicial reforms. And I've stated and continue to state that they have to be done, and it's imperative that they be done in a way that preserves the strength and independence of the institutions, and it's done in a way that is widely agreed upon across society.
The other thing that we've been hearing at Bloomberg is that more companies are looking at moving cash out of Israel, that there's concerns, especially in high-tech investments, that's going to be reduced amounts going forward because of the political volatility that's beginning to take shape. Is the central bank seeing any evidence of that, or do you have any color that you could provide on that front?
We obviously monitor a lot of the financial issues. We have not seen a macro effect of the type that you've mentioned, but clearly the uncertainty that is brought about, makes investors, whether they're inside or outside, judge things a lot more carefully regarding where the developments might be regarding these judicial reforms.
Governor, thank you for making the time. I know you've got a lot going on in your schedule, and I do hope we speak again in a formal and an informal capacity, as well as Governor Amir Yaron there from the Bank of Israel. Manis?
Yusuf, thank you. Great conversation there. The governor telling us well-anchored inflation expectations as the RBA calls a peak in from Israel, the RBA to arm. There are banks out there, and they are quite literally salivating. Breaking news. The bankers to arms IPO, they are going to go ka-ching, ka-ching, ka-ching. $100 million. They're going to get 2% fees, 1.75% and 0.25% as an incentive. This is what we've got for you. The listing of 28 banks. And just think some of the big names out there. You got Barclays, you got Goldman's, you got JP Morgan on the roster, along with Mizuho. So you understand it breaks down like this. You're going to get 1.75% on the actual business. And then you got an incentive. Bankers like an incentive, 0.25% incentive fee awarded at the firm's discretion. So if you roll up with a blockbuster pillar investor, get ready for your 0.25%. Christmas could come quite literally early. This is the chip firm listing, the ARM listing, which is going to be perhaps one of the biggest ones this year. Payday for ARMs. There's money in chips. There's Barclays down 0.6%. The investment bankers could do with a break. Coming up, I caught up with the Chevron Whetstone downstream staff. And what's on offer? Let's find out. Is the walkout on at Chevron? We'll get an update on the industrial action in Australia, what it means for the LNG market right here on Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
We've all been there. You get invited to go to Kyrgyzstan, where there, you're turned into a YouTube kids show star. Build a satellite and play a game with a goat. The point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
We're committed to find a solution there, and we want to find a solution that's a win-win-win. We want to find it as a win for Chevron, a win for our employees, and a win for the gas markets.
Colin, let me follow up on that, just to give our global audience some perspective on how heated the rhetoric is. This is a quote from the Offshore Alliance when they made a statement. The log of claims will ultimately be claims which Chevron will agree to, but not before they lose a few $1 billion, judging by the form guide, which is okay, as Chevron clearly have plenty of loose change in the Chevron piggy bank. Do you have any timeline as to how quickly you're willing to resolve the standoff?
No, so I mean, if I go back and really just to kind of repeat what I said before, there are active conversation, there's active dialogue going on at the moment. So I'm really not going to comment on things that are around the edge, but to say that, look, we're really committed to find a solution here, and we want to find a solution, and we understand solutions. You have to get a space that's a win for various parties. So we understand that it has to be good for our employees, it has to be good for us, and all of that will be good in the LNG market. So really, that's what we're committed to do.
Yep, that was an interesting conversation there with the president of the midstream area, Chevron, Colin Parfitt, speaking to myself and Yusuf a little bit earlier, an exclusive interview there. Coming up, we've got more news on the Chevron Wheatstone downstream staff in Australia. They've offered to work during the upcoming notified strikes to ensure domestic gas supplies. So let's get the very latest on the European gas markets with Anna Shiri-Iveskia. Anna, here we go. Last week, I had Woodside Petroleum talking about a febrile market. Here we are. We're looking at the risk of 7% of the global LNG market going out for a period of time. What is the latest?
Indeed, the deadline for the start of strikes is rapidly approaching. The workers at Wheatstone and Gorgon LNG plants in Australia threatened to start partial strikes on the 7th of September, and followed by full 24-hour rolling outages for 2 weeks, a week later, next Thursday. As Mr. Parfitt mentioned, of course, talks are continuing between the labor unions and Chevron, so there is still hope the strikes could be averted. And as we heard recently, Wheatstone downstream facility workers will offer to work during the plant industrial action. That only refers to the domestic gas supply plant to ensure Chevron continues working to repair that plant after an outage and to ensure that Australian domestic consumers do not suffer.
So then we often look at the supply situation for Europe. There's going to be this competition. If there is an outage of some description in Australia, it's going to be Europe bidding against other buyers, Asian buyers, for Aussie gas. How full are the tanks? Are we ahead of the curve? Are we ahead of the normal storage at this time, which causes so much angst last year when, of course, Russia went to war against Ukraine?
Well, it's worth noting that Europe does not directly receive any Australian LNG, so if there's any outage, it will affect Asian customers. But we shouldn't forget that at the moment, we are still in a low demand season. We don't have any heating season starting yet anytime soon for the next few weeks. The demand is still muted both in Asia and in Europe in particular. So for Europe, there is no immediate concern. Storage sites are 93% full. There are preliminary forecasts that the weather will continue to be mild into October, so that could potentially delay the start of the heating season. And we've seen actually over the last 2 weeks that LNG flows to Europe continue quite strongly. That's mainly supplied from the US. So there is no immediate danger at the moment, even if the strikes do start in the coming 2 weeks.
Anna, thank you so much. That is the very latest on the gas markets there with Anna Shiri-Iveskia. Well, big tech is bracing for the European Union's biggest ever clampdown on anti-competitive practices, which may provoke a new wave of legal battles between the regulators and Silicon Valley. Now, the announcement on which tech platforms are to be targeted under the EU's Digital Markets Act is due tomorrow. What will be in it? What will it mean? Let's bring in our EU competition reporter, Sam Sultan. Sam, what is the objective of these new rules? Because we've had quite heated sparring over technology in the past sort of 6-7 years. What's new?
Well, hello there from Brussels here. And yes, these new rules don't actually come into play until early 2024, but the Commission is releasing a list of those platforms to come under the scope of those rules tomorrow. And it's really intended to stop at source many of those anti-competitive behaviours that we've seen over the past couple of decades in which Brussels has taken issue with. Of course, we've seen many bitter battles played out between the European Commission and the likes of Apple or Google through the EU courts. And this regulation is really intended to stop those and to prohibit certain behaviours before they come to market.
So which platforms, I mean, we've just shown a whole series of logos there across the spectrum. Which platforms appear to be on the list? And what are they going to have to do to make reparation or changes? What is the next steps?
Well, really, of course, that list is still to be confirmed tomorrow, but we have a preliminary idea as to the companies that will face the new rules. And you can safely assume, because there's a series of quantitative thresholds that certain platforms have to meet in order to be designated, we can assume that the likes of Apple and some of its operating services will come under the scope. The App Store will also be included there. And what this will actually mean, for example, is that Apple may actually have to allow users to download certain apps from outside of the App Store. So conceivably in the future, we could see iPhone users downloading apps on their iPhone, but from alternative app stores. Other companies like Meta, for example, is likely to see the Facebook social network come under the scope of the rules, as well as Instagram. And some of the obligations in the DMA will mean that Meta can no longer, for example, share data between those different platform services without first obtaining user permission.
Okay, let's see what is in the belly of the report. That is our Bloomberg EU competition reporter, Sam Stolten there. Coming up, are you working from home? Are you in the office today? Well, the post-pandemic dilemma could be $1 trillion problem. That's in the years ahead. We dive into today's big take right here on Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Most aspects of life have returned to normal in the emerging post-pandemic era. Moviegoers, they're flocking to the cinemas, tourists are jamming the airports for the summer travel, and the kids are returning to the classrooms. But one thing is not back to normal: the return to the office. That's the topic of today's Big Take. Let's bring in Irina Ankel on this story. The return to work, the patterns are different depending on where you are, aren't they, in terms of the countries? Who's back in the office and who's lolling at home on a Monday and Friday? Good morning.
Morning. So the US is actually lagging Europe and Asia in the return to office push. Only half of Americans are back in the office compared to over 75% in Europe and in the Asia Pacific region. Europe's habits vary widely, but several of its countries are leading the way with laws enshrining flexible schedules. Whereas in the US, policymakers stayed silent and they left bosses and employees to navigate changes on their own. And another interesting trend is around digital nomads, so people who move to work remotely from entirely new locations. Now, they used to flock to Portugal and now are looking outside the US and Europe, actually, after rent prices ballooned in Lisbon. And the fastest growing remote working hubs are actually in Asia, in cities like Tokyo and Seoul.
Yeah, and there's a whole influx of those digital nomads here in the UAE. The Big Take. Hop on your Bloomberg, pick up Irina's story there. Irina Ankel, you can read it all on your terminal. Let me give you a quick flashcard of what is going on. I think the dollar is the most dominant story as the Aussies call peak rates. Was it that hawkish a hold by the Aussies for the third time? The Aussie has collapsed by 1.3%. Goldman's might be writing for the savior, saying that you could have another rate hike in November, but it's not looking like the market believes that. We're in the calibration phase. The Aussie tanks on the back of weaker Kaishan numbers, and that is it. The services sector in China is under pressure. The dollar is the alpha. Who said exceptionalism was dead? The dollar is up by 0.5%. It takes its best day in a month as we go risk off in equities, resplendent in red on the equity column right here on Bloomberg. The dollar is king dollar. Good morning.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, you ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
From the world of politics to the world of business, every weekday at Eastern Time, only on Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. More fresh data trickles in as ECB officials ponder whether to hike or hold next week. Europe services data was weaker than forecast, while consumer inflation expectations inched up. Meanwhile, in China, disappointing data adds to concerns for the country's recovery. Bloomberg Economics says China may never overtake the U.S. as the world's biggest economy. And Goldman Sachs gaining confidence in the U.S. The bank now sees a 15% chance the U.S. will slide into recession, down from 20. Welcome to Bloomberg Surveillance. You're watching the early edition. I'm Danny Berger in London. Sonali Basak is in New York. Sonali, we've had a lot of European data trickle in this morning. More breaking just now. Euro area July producer prices fall 7.6% year over year. That is bang in line with estimates. However, the month-over-month figure is slightly less of a fall than expected. 0.5%. The estimate was for 0.6%. Yet another set of data that shows inflation maybe not coming down as much as expected, while there's still those growth concerns rife. But how's the U.S. looking, Sonali?
Yeah, when you take a look at those growth concerns, you see it in the market. Certainly, you're looking at the S&P starting the day lighter on the day. You're seeing a little bit of a risk-off tone here in the United States, Danny. S&P futures down about 0.2%, just under 0.3%. You're also watching a little bit of a tick up in yields. The two-year yield up about 2 basis points at a 4.89 handle. That is about where we were a week ago. So a lift in yields, a little bit of a bond sell-off. That lift in yields feeding through to the dollar. King dollar, this is a level, the Bloomberg U.S. dollar index at the highest level since March of this year. Higher for longer despite the concerns about divergence among central bank policies. We'll keep an eye on that dollar all week. And Brent crude, a little bit of softening now, down about 0.6%. This is an area where there has been a little bit of volatility. Earlier, we had seen about an 89 handle. But again, Brent crude down just a little bit on the day, Danny.
Yeah, it's pretty remarkable to look at the risk-off session that's taken hold of the global market, Sonali, because on the surface, it should be a good news day. We're going to get into all these things, but things like Country Garden paying down a U.S. dollar-denominated bond, things like Goldman Sachs upping their forecast for the U.S., you think that we'd have something of a risk rally. We're not getting that. As soon as the European session started well underway around 8 a.m. is when you saw this sell-off taking hold. Now, some of the data hasn't exactly helped. I mentioned the producer prices, the fall there basically in line, not as much when it comes to the month-over-month figure, but we also had services revised down. So what do you get? You get stocks down 0.5%. You get all the high beta currencies. They've been crushed so far this morning. Cable weaker by about 0.7%. The Aussie dollar, we did did have an RBA decision. They don't do anything as expected, but this is falling with the likes of Brent, for example, Shonali, with the likes of the Kiwi, Aussie falling 1 1/3%. So some of that European data not necessarily showing up in the market action, but it does add to the gloom. To go through all of that, we did have consumer expectations for the euro area inflation inch up in July, still well above the ECB's 2% target. Let's get over to Bloomberg's European correspondent, Maria Tadeo. Maria, we're on countdown for the ECB decision. Talk us through the numbers. How's it stacking up?
Well, I know I am. Look, the European Central Bank is in a very difficult spot, and this decision coming up on September 14th will be a very difficult balancing act, because you yourself, when you're running through all the different data, you could see that the data points at times contradict each other, but also contradict some of the statements that the European Central Bank also made just today. You had Philip Lane, who said on the medium term, he believes that core inflation will come down. He also said that there was now some evidence that goods inflation, services inflation is moving down, and then almost 2 hours later, you had that report that came out from the European consumer inflation expectations, which measures just really the pulse of the European consumer and where they see prices going. And you saw that on the 12-month basis, it was unchanged, but on the 3-year horizon, it actually picked up. So that is the wrong direction in terms of what the European Central Bank wants to see now for that monetary policy decision, which, as you say, could be a hold or a hike. What the European Central Bank wants to see is that inflation is moving on a sustainable path to 2%, but also, and this is key, and we've heard it repeatedly, that the transmission is strong enough, is operating well enough in the economy that it would lead to a pause if there was a pause coupled with the delicate state of the economy. If not, that rate hike in September would still be up for play. And some of that commentary echoed by the Belgian central banker, who today said perhaps a bit too early to rule out a hike, but again, it will hinge on the data. I think this is one of those decisions where we will really have to wait until that decision day to clarify those doubts. It's very hard to read the way they want to go.
Talk through some of the regional differences here, because we're looking at key data coming out of France, out of Germany. And are you seeing real differences in the way that the economies are heading into these key decisions?
Look, I think we used to see big differences between the services economies and the industrial economies. Obviously, we know that the German economy is in a very tough spot. We know that the Chinese downturn could really affect the German economy. We've seen for months now, this is, well, not a secret in terms of the implications of the energy crisis that it had in this economy, that the industry, the German industry, it is in contraction and it is in pain. What is changing now is that a lot of the services that used to offset that are also moving in the wrong direction. They're moving in contraction. I think if you look at the PMI's numbers, it reflects that. So not only you're seeing a weakness that is spreading, but also that perhaps shows services will not come to the rescue to that manufacturing downturn. So a lot of this painting a picture that would show, again, as the European Central Bank says, that there is weakness in the economy that could lead to more downside risks for the European economy in the back end of the year.
Yeah, it is also rare to get that revision down for so many different regions for services, that sort of trend. Maria, thank you so much.
Very good point.
Maria Tadeo. All right, we're going to go from Europe to China. And also, thank you, Maria. Thanks for the compliment. I heard it. Europe to China. As Chinese developer Country Garden avoided its first default, it had a last-minute U.S. dollar coupon payment. Let's get over to Rebecca Chung-Wilkins, Bloomberg Asia government and politics correspondent. So there we go. Finally, avoiding default, at least for now. Rebecca, what's next?
Yeah, it has been this month of will they, won't they default for 30 days, but the firm there telling note holders apparently that they have paid within that grace period and therefore averted what would have been their first official default. Now, Country Garden isn't really out of the woods yet, and if you look at the bond pricing there, 13, 14, 15 cents on the dollar, you can see investors pricing in a very low rate of recovery, actually. There are 4 more bond maturities that Country Garden will need to deal with, and there's another coupon payment actually also due this month. So the firm still needs to raise about $500 million US. the fact that they struggled so much just to raise $22.5 million to avert default on these two Bolo coupons doesn't necessarily bode well, does suggest there's still going to be some excitement around whether or not they can continue to pay. The other thing to watch next is September is going to be a very, very busy month for other private developers that, like Country Garden, have so far avoided default. It is a hefty maturity wall, $1.5 billion US that they need to pay in onshore and offshore debt just this month. It is the biggest maturity wall that these 16 developers that have so far avoided default will have to raise this year.
Speak more to the stresses in the property sector. Is there anything the government can be doing to stem more of that stress that's under the surface?
Well, we have seen this sort of raft of measures to try and support the property sector, including in some of China's bigger cities. Now, that was welcomed by investors. It has been called for, and some really have said it's really overdue. We are yet really to see some of that support actually showing through, for example, in data, services data, and so on. And for many property firms, the big concern is whether we see this stress that so far has been relatively contained, particularly when it comes to defaults in the private sector, whether that starts to sort of spread into the state sector. Now, we had a significant jump in the number of state firms, property firms, that said they might struggle or have warned of some kind of profit loss for the first half. Obviously, it still looks like it will persist into the second half because we haven't had any kind of real bazooka property stimulus so far. But the question is whether they can then move into a phase where they actually start consolidation. That's the ideal end goal for Beijing, is for these big state developers to come in and help support these smaller defaulters.
Well, I gotta say, Rebecca, it seems like all of those concerns are undoing the rally we saw yesterday. Rebecca Chung-Wilkins there, thank you so much for that. Now, from China to the U.S., Goldman Sachs now sees a 15% chance the U.S. will go into recession. That's down from 20% as a result of cooling inflation and resilient labor markets. Joining us now is Bloomberg Markets reporter Valerie Teitel. Valerie, Goldman typically has been a bit more optimistic than most economists out there, but this is starting to feel like a lot more optimistic.
Definitely. This is now the second time in just 2 months that they've revised down their chances of a U.S. recession in the next year, now down to 15%. And if we look at the Bloomberg consensus, it's 60%. So they are a lot more bullish than the consensus on the trajectory of the U.S. economy. And I think the difference there is that many other economists are citing these risks that the consumer is going to run into in the fall, especially when it comes to the fact that we have the student loan forgiveness done by the Biden administration that rolled off on the 1st of December. So that's going to be a headwind for the consumer as we head into the third quarter. But the reasons why Goldman made this change to their forecast was based on last Friday's labor market print, that almost Goldilocks print that the Fed got. We are seeing this cooling in the labor market. It's not falling off a cliff, Danny. It's just cooling slightly. And we're seeing that progress on wage inflation with average hourly earnings now running the lowest they have in over a year. So those are the reasons for the change in Goldman's call, but there still are some risks on the horizon as we head into the third quarter.
And before we have some key data to watch into next week when we look at CPI and other key data points that will tell us the future of the U.S. interest rates, there's still a lot this week. Valerie, what are we looking forward to in terms of eco data and conversations coming out of the Federal Reserve?
Yeah, exactly, Sonali. There is a few things on the calendar this week. It is a light week when it comes to data. We do get ISM services tomorrow. We also get the Fed's beige book out tomorrow as well. But I think a lot of the attention is going to be on the Fed speak. We have the blackout period beginning on Saturday. So this is really the last chance for those Fed speakers, especially those voters, if they want to, change the narrative slightly in the market. This is their last chance to do it. A lot of the attention is going to be on whether we see a kind of echo of Powell's Jackson Hole speech, where he really said that they need to see some sort of economic weakness before trusting this deceleration in inflation. Do we see those same kind of comments from those 8 Fed speakers later this week? That is what the markets will be watching.
At least their last chance to do it on the record. Valerie, thank you very much. Bloomberg's Valerie Teitel. Okay, coming up later this hour, we're going to be catching up with Henrietta Pacamont, head of global fixed income at Allspring. But first, up next, Chevron LNG workers in Australia threatened to go on strike as early as Thursday. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London, alongside Shonali Basak in New York. Chevron liquefied natural gas workers are threatening to strike as soon as this week at two major export plants in an escalation of a dispute that threatens global fuel supply. Bloomberg TV spoke exclusively to Chevron's president of midstream about the risk of strikes.
We're committed to find a solution there, and we want to find a solution that's a win-win-win. We want to find it as a win for Chevron, a win for our employees, and a win for the gas markets.
Colin, let me follow up on that, just to give our global audience some perspective on how heated the rhetoric is. This is a quote from the Offshore Alliance when they made a statement. The log of claims will ultimately be claims which Chevron will agree to, but not before they lose a few $1 billion, judging by the form guide, which is okay, as Chevron clearly have plenty of loose change in the Chevron piggy bank. Do you have any timeline as to how quickly you're willing to resolve the standoff?
No, so I mean, if I go back and really just to kind of repeat what I said before, there are active conversation, there's active dialogue going on at the moment. So I'm really not going to comment on things that are around the edge, but to say that, look, we're really committed to find a solution here, and we want to find a solution. And we understand solutions. You have to get a space that's a win for various parties. So we understand that it has to be good for our employees, it has to be good for us, and all of that will be good in the LNG market. So really, that's what we're committed to do.
Chevron's president of midstream speaking with Bloomberg's Manus Krani and Yusuf Gamal Din. Joining us now is Bloomberg MLive editor Eddie Vanderwalt. Eddie, you know, I was prepared to talk about nat gas. It's down, Brent is down, all the high beta stuff is down. I mean, those strikes don't seem to be what's moving things here. It's almost, what, have we decided yesterday was just a make-believe day? It didn't count?
Yeah, absolutely. Look, there's a lot of negative news in the market at the moment. Those strikes, I think they won't matter for the near term for Europe, but I think if they drag on late into the winter, at the moment, Europe natural gas, supplies are very well stocked, something like 92% full at the moment. So but as we get late into the winter, if we can't replenish, then maybe some Australian gas will have to come in. As far as the high beta, the market generally turning much more sour. I think on the PMI numbers from Europe, those have come in significantly below expectations. Now, there is this sort of weird moment in the market where there is good news, bad news, or is it not? I think the fact that services in particular coming in below expectations, I think that really matters for people.
You're also seeing the bond sell-off really continue into the U.S. as well as the stock sell-off. Talk about what that data really means for the global risk-off story, especially when the real bid you're really only seeing is in the dollar.
Yeah, absolutely. The dollar is the big mover here, and I think that's been the case for the last year or so. When you see the dollar up, you generally see markets broadly down. What's interesting about the yield curve is that we are seeing more of that steepening at the moment, right? I think as long as it's steepening where we're seeing the long end lifting, so if you're seeing that kind of bear steepening, then I think that is actually really good for broader markets, because that means that we're not having a spillover, we're not seeing a recession that's forcing the Fed to cut rates at the front end. And I think, therefore, the steepening, particularly at the back end, probably helps the market more than anything else.
Believe it though, Eddie? Aren't we about to get a bunch of corporate bond issuance? Are we not just trying to adjust for that?
Yeah, there is absolutely a risk that we reprice all of this, and this is what happens when you're in a data-dependent world, isn't it, right? If you're without forward guidance, that means that every new data piece that comes in has to move the market so much more. So I think when the Fed says data-dependent, it is also saying heightened volatility.
All right, Eddie, thank you so much. Always a pleasure to have you on. Eddie Vandervalt there with the Market Roundup. And for more excellent analysis from Eddie and the team, and Live Go is where you want to head on your terminal. This is Bloomberg.
Names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London, alongside Sonali Basak in New York. Now, some of the stories that we've got our eye on this morning with a little bit of deal flavor to them. Starting out with CVC. It's said to be nearing a deal to buy DIF Capital. It's an effort to grow its range of offerings ahead of a potential listing. Infrastructure manager DIF has around 16 billion euros of assets under management, according to its website. The deal announcement, Sonali, could come as soon as today.
We're going to stick with private equity because we have Thoma Bravo. It's said to be near a deal to buy NextGen Healthcare. The health record software firm NextGen had drawn interest from several other buyout firms before these talks advanced with Thoma Bravo, according to a Bloomberg source. The deal announcement could come as early as this week, Danny.
Now, over in Hong Kong, shares of skincare brand L'Occitane are falling by a record 28% in the pre-market session after the chair ends talks on a potential deal to take the firm private. Now, the company said in a filing on Monday that the controlling shareholder has decided not to proceed with the transaction. But Sonali, there was no reason specifically for that decision.
And over in the IPO world, remember that investment banks are working on ARM's IPO, and they're said to be sharing upwards of $100 million in fees from the listing. Bloomberg is learning that ARM Holdings will pay 2% of the $5 to $5.4 billion it's seeking to raise in the public offering to those banks. Now, long-awaited set of fees for a drought that has been the worst IPO drought, Danny, since 2009.
Yeah, and that makes me wonder, Sonali, just how much is at stake with this IPO. Finally, we're going to get the mega IPO coming back to the market. But is a flop, if it's a flop, does that just kind of cement then, Sonali, okay, maybe it's still not the time. We're still not yet in a place where you can exit via going public.
It's interesting because you have already seen valuations come down meaningfully. You had SoftBank set the floor by buying its ARM stake out of the SoftBank Vision Fund. Now you also have ARM lining up its biggest customers, Apple, NVIDIA, to be as strategic investors for this IPO, yet you're already seeing expectations starting to be a little bit muted relative to where we were a week ago. They're seeking to raise $5 to $7 billion, but that could end up in the range of 50 to 54 billion in valuation. Remember, SoftBank bought that stake at a $64 billion valuation. And so already, remember, super sensitive time in the market. You're watching CPI data ahead. You need to get these capital raises really in before you start to hit choppy markets potentially from that economic data and any adjustments here of rate expectations.
Yeah, that's the thing, right? SoftBank just had such lofty expectations for ARM. And we're in this moment where it's almost like the market is about to issue a verdict, and the verdict maybe doesn't look as lofty as it is. But Sonali, the thing that we can potentially hang our hat up on is that maybe we'll finally get some stability. Sure, maybe rates will be high, but I got to assume that if they do plateau, we're not in a volatile rates environment. That at least has to be a little bit more friendly for some of these markets, for bringing companies to market, for raising funds, that sort of thing.
And remember, investors are starved here for new deals when it comes to IPOs as well as bond issuance. You're also not only seeing the IPO market ready to come back in a little bit more force, you're also seeing bond issuance this week. We were talking about corporate bond issuance on the investment grade side coming back, and also leverage loans to the tune of about $15 billion. Now, that is not much compared to prior years, but it is certainly welcome for investors that are looking for some yield in this market that has been starved of deals.
I was going to say, today is the day historically when we get that bevy of corporate bond issuances. So something to look out for and something that might continue to hit duration. Speaking of which, coming up, we're going to be speaking to Henrietta Pacmont, head of global fixed income at Allspring. That's next. This is Bloomberg.
You have big plans to expand Visa's business in Africa. Tell me about them.
Well, this is one of the most exciting places in the world, and we believe that it has only really begun. There's been so much progress in the last couple of years, the last 5 years, but the progress that I see and the possibilities that I see for the next decade are incredible.
Why Africa now?
There's lots and lots of opportunity here. So this is a time and place where I think the infrastructure has advanced. It still has ways to go, but it has advanced that it creates a good on-ramp for us. And we heard yesterday from the Secretary General of AFCFTA. I think that is a critically important platform. This idea of taking a pan-African approach is critical for companies like ours to invest, because we can count, what we're trying to count on is having a level of standardization and interoperability across the continent that makes it easier for us to invest in a broad-based way, as opposed to having to create bespoke solutions in 54 different countries.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know for the day. More fresh data trickling in as the ECB officials ponder whether to hike or to hold next week. Europe's services data was weaker than forecast, and while consumer inflation expectations inched up. Meanwhile, over in China, disappointing data adds to concerns for the country's recovery. Bloomberg economics say China may never overtake the United States as the world's biggest economy. And Goldman Sachs gaining confidence in the United States. The bank now seeing a 15% chance the U.S. will slide into a recession. That's down from 20%. I'm Sonali Basak in New York with Danny Berger in London. Danny, what is Europe looking like today?
Well, Sonali, you'd think that after rally yesterday, we could maybe keep it going. I mean, we had good news in terms of Country Garden repaying some of its dollar-denominated bonds. You had Goldman Sachs upgrading their view of the economy. However, with the U.S. online, it's decided that we can't make any decisions without it, because all of that has been undone. Perhaps we decided that the China rally was too far overgone, that the Europe data was bad. So you have a drop of about 0.1% in European stocks. But all the high beta FX, this is where the action is really taking place today. Sterling, it's off some of its lows, but still moving lower, about 0.6%. Euro also looking weak this morning off the back of services data that was revised down, and other places disappointed. Finally, Aussie dollar, that's down by 1.25%. This really exemplifying, Sonali, just the risk-off high beta kind of move that we're seeing at the moment.
There's certainly more risk-off over here in the United States as well. You're watching a little bit more of that sell-off taking steam in the U.S. You're watching the S&P futures down about 0.2%. That is a little bit better than what we saw earlier today, but we'll see how the market opens. The two-year yield, though, gaining some steam with that bond sell-off. We're now at 4.90, up about 2 basis points. We're looking at that two-year yield. We're also talking about the dollar, because the dollar is really where the bid is in the market. That Bloomberg U.S. dollar index at the highest levels since March. Brent crude still facing a little bit of pressure there, down about 0.5%. Looking at an 88 handle there, $88.52, Danny.
Yeah. I mean, and I know, Sonali, that at the same time, you've also got your eyes on equities, a new call out from Mike Wilson's Morgan Stanley.
Yeah, absolutely. He's sticking with those late cycle winners like industrials and energy over consumer discretionary and small caps. He writes, quote, markets are now expecting a meaningful reacceleration in growth that he thinks is unlikely this year, especially for the consumer. To talk more about that, we're going to talk to Henrietta Pacamont. She's Senior Portfolio Manager and Head of Global Fixed Income at Allspring Global Investments. Great day to talk about bonds. You're watching those worries about growth really filter through the market here, watching that bond sell-off continue into the United States. How much more pressure are you expecting?
So yeah, we've still got this tussle between inflation and growth.
I think we have had some weaker data, particularly out of certain geographies. I'd say Europe and China in particular. We saw the numbers today, but even in the US with some of the employment numbers that came out on Friday. So I think that is a consideration for the market, particularly as risk assets have had a bit of a good run and are pricing in a sort of soft or no landing at this point. So I think it makes sense. On the rate side, well, inflation is still a thing. We're getting stickiness on the services side, and you are getting a bit of movement on the commodity side as well. So still something to look at.
It's certainly still a thing. Also, I love that phrase, by the way. It is absolutely a thing, Henrietta, especially in Europe. And it's this push and pull. At least you can kind of see it play out on the front end of the German curve, really stuck around 3%. Which is going to win out more, that inflation stuck in a range or growth that keeps coming out weaker? Where is the next breakout for the front end of the German curve going to be?
Well, I think the ECB is in a tricky spot at this point. Yes, we are sort of seeing these this turn in terms of numbers from a growth perspective. But inflation is higher in Europe than it is in the US, so that does put it in a tricky situation. I mean, if you look at Christine Lagarde, she's at pains to say that they are data dependent. So it'll be really interesting to see what they do later on in September with the more information that they will have between now and then. I think it's very finely balanced as to what they do. 3.75, 4%. They're probably in the range that they want to be in at this point and not have to hike too much more from here.
Yeah, I would say she's almost at pains to say nothing. I feel like she seems very concerned about, showing her hand either way, whether it's hawkish or dovish. Does that mean that ECB speak, maybe we kind of put that to the side and it's all about the data that we need to be trading around?
I think you need to look at the data. I think you need to see what's coming in. I think it's not just the ECB, to be fair. I think it's the Fed as well. But the ECB is in a slightly trickier situation with maybe a little less flexibility than the Fed at this point.
Now, Henrietta, I want to talk to you about the Goldman Sachs call a little bit about the U.S. recession odds, down to 15% from 20%, because Jan Hatzius had argued the following, that real disposable income looks to reaccelerate in 2024 on the back of continued solid job growth and rising wages. And second, they still strongly disagree with the notion that a growing drag from the long and variable lags in monetary policy will push the economy toward a recession. Do you share his view, or are there risks that he's wrong?
Well, I think it's an optimistic view, but then you look at what's happened since the beginning of the year, the US economy has surprised. The consumer has been a lot more resilient and a lot more willing as well to spend the sort of nest egg that they built up during COVID. We'll have to see if that continues. I do think that, yes, there are some after boosters, what Goldman Sachs mentioned, but also some of the investment packages that have come out in the US. I'm thinking the IRA, for instance. So there are reasons for optimism, but there is a lag. We have had a pretty aggressive rate hiking cycle, and that does leave traces. We are getting towards the end, maybe as well, of some of the COVID savings. There's the change as well in terms of student repayments. So it's not as clear-cut, maybe, as they think.
As far as the equity side goes, it's been very hard to kind of argue the bull case this year, but there are expectations that there are certain catalysts that could make the rest of this year somewhat choppy. How choppy do you think that this year could get?
I think that's right. Equities have come a long way, and also you have to remember that the bond world has come a long way in terms of yields. So it does have a place in the portfolio more so than it has in years gone by. So diversifying between bonds and equities at this point, we think makes sense. It gives you a bit of an option on the growth side, but if growth does disappoint, which is an option, you've got a bit more protection if you've got some bonds in your portfolio.
Henrietta, I'm not even ready for the rest this year. I'm still trying to get through this week. I mean, this is the day, right, where we get all this corporate bond issuance. I think it was $35 billion on the Tuesday after Labor Day last year. What are you expecting this time around?
So there is a seasonal aspect to September. You do expect more bond issuance. We're certainly seeing that on the investment grade side. We're expecting that to hit on the high yield side as well, possibly on a relative basis more on the European side than on the US. So this has got a degree of normality. Maybe it's accelerated ahead of some potential volatility later in the month. That could be what we're seeing at the moment. But issuance went well last week. Books were well covered. There is some selectivity from investors, so different issuers are having to come with different new issue premiums, but so far so good. And there is cash to spend in the investment grade portfolios, in the high yield portfolios, in anticipation of this new issuance.
Does that mean some calls of high yield's demise are a bit too premature at this point?
High yield's an interesting one. Yes, if you are concerned about the economy, it's one to treat with care.
Right.
And what we've seen with investors so far is they've focused on yield, particularly on the short end. Maybe now it's an interesting one to sort of lengthen out, get a bit more protection from a duration perspective. We need to keep an eye out in terms of the refinancings on the high yield side. A lot of short-dated bonds in high yield, probably one of the highest ratios on the European side between 1 and 3 year in terms of maturity. We need to see how that gets refinanced over the next little while.
Allspring's Henrietta Paquan, we thank you so much for your time and your analysis. Coming up next, we're going to talk about big tech bracing for the European Union's biggest antitrust crackdown. We'll discuss that next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Shonali Bassick in New York. Big tech is bracing for the European Union's biggest ever clampdown on anti-competitive practices, which may invoke a new wave of legal battles between regulators and Silicon Valley. The announcement on which tech platforms are to be targeted under the EU's Digital Markets Act is due by tomorrow. For more on this, let's bring in Bloomberg's EU competition reporter Sam Stolten. Sam, I feel like I've been hearing about this for a while, and finally we're going to get something concrete from it, but catch everyone up. What exactly is the objective of these new rules?
Well, yes, indeed, it has been long in the works. The Digital Markets Act effectively aims to stop at source some of those anti-competitive practices that big tech has been accused of, particularly here in the EU over the past couple of decades. Now, the rules don't actually come into play until early 2024, but a really important development is happening tomorrow when the European Commission lays out a list of those services that will face the new restrictions.
Who will face the new restrictions, and what will they have to do to fight them?
Well, effectively, that's the announcement tomorrow. There are quantitative thresholds that certain core platform services, as they're called, have to meet in order to be designated. So we can have a general idea about the types of services that will come under the scope. A number of Apple services, for example, are expected to meet the thresholds required to come under the Digital Markets Act. And that will mean that, for example, in the future, iPhone users may be able to download apps from outside of the Apple App Store. And indeed, they will be able to download them from other online platforms, such as potentially the Google Play Store on iPhones. Elsewhere, if Meta finds that some of its social networking services, like Facebook and Instagram, come under the scope of the new rules, then it will have to ask users before it combines user data before those types of before that will take place. So a lot of these services are still to be designated tomorrow, but that's really the list that we're waiting for.
Yeah, I mean, Apple has been such a gatekeeper there. It would feel like such a change for me to be able to log on to the store here and download something from Google. Look, Sam, before we get to any of the enforcement of these new rules, could there be any legal challenges?
Potentially, yes. And I mean, if any legal challenges do come, or any form of legal wrangling over these new obligations and prohibitions, they're likely to come relatively soon, not too long after the designation process tomorrow. And it will really center around what platform services some of those big tech gatekeepers believe should be designated, and maybe where the European Commission disagrees with those decisions. So, for example, one company that has been relatively robust in saying that it doesn't think some of its services should be designated is Microsoft. Microsoft says that Bing, for example, is too small a competitor to Google to be designated under the new rules, and that's despite Bing likely meeting some of those quantitative thresholds to be designated. So there's lots of legal wrangling potentially in storm in response to some of these new rules and restrictions. But on the other side of things, the parts where the platforms will comply with the new rules will require quite a lot of re-engineering of some of those core digital services that have become a concrete part of our everyday lives.
Yeah. Sam, thank you very much. That's Bloomberg's EU competition reporter, Sam Stolten, in Brussels. Now, over 3 years ago, millions of office workers were sent home at the start of the pandemic. Now companies are still struggling to get them to return. That's the focus of today's Big Take. A great piece. Joining us now is one of the authors on that, Bloomberg's Irina Engel. Irina, this is so fascinating because looking at some of the differences per country, I gotta say, it makes America seem so antisocial that Americans just do not want to return to the office and see people.
Well, it's right. Just as we have national dishes, now we seem to have different national flavors of returning to the office. The US is lagging Europe and Asia in the return to office push. Only half of Americans are back in the office compared to over 75% in Europe and in the Asia Pacific region.
Why the differences? Why is it that Americans don't want to be back?
Well, it's two things, actually. It's culture and the way cities are built. If you look at China, where you have very high rates of office attendance, that's also where you have the 996 culture, which involves working from 9 a.m. to 9 p.m. 6 days a week. Also, loyalty to employers is more steadfast in places like Japan and South Korea, say, than in the US. And workers in Europe and Asia are more concerned about missing out on social connections with coworkers than Americans are. And finally, it all comes down to your home setup and your commute. European cities are more walkable, and office areas are connected to vibrant communities. By contrast, in the US, offices are more isolated and dictated by zoning laws.
So for places like the US, what does it mean for commercial real estate?
the picture is not looking great. McKinsey estimated that pandemic shifts could erase as much as $1.3 trillion of real estate values in big cities around the world by 2030. And now the value of being present in the office in different cultures is directly linked to property values. So landlords in countries where work from home is more popular are the hardest hit. Office-heavy areas of New York or San Francisco have suffered steeper declines in real estate demand alongside lower rates of office attendance. And that's compared with cities like Paris and Munich or Asian cities which value being in the office more.
Our thank you to Bloomberg's Irina Angel on a very widely read story today. Coming up, a look. Oh, actually, no, wait, Danny, I want to talk a little bit more about this story. Because this is
Shanali, we can't go yet.
Post-Labor Day holiday in the United States here. Not only am I back, but something funny about the United States, about people coming back into work, is that you have the big banks saying, come in, everyone's needing to be back 5 days a week. Interestingly, though, their clients had a work from anywhere August. A lot of the big private asset managers, which means that today, right now, you and I are speaking to people that are being dragged back in, that have not been in New York, let alone the office, for 3 or 4 weeks.
Look, I kind of do feel for a lot of people because obviously, Chanel, you and I have been in the office for most of the pandemic too, let's be honest. But look, if you were someone whose work gave you that flexibility, and let's say you were in New York and then you say, hey, I'm gonna go move out somewhere in Connecticut, somewhere that's a 2-hour commute, because work is letting me do that. For some of these firms that are changing and saying, actually, we want you back in, it's extremely difficult. You can see why some people are saying, if work asked me back in, I would not go back in. All those surveys show that in America, that problem is especially acute. And again, it gets me back to the thing that, again, in this big take, America literally comes off as the most antisocial country in the world.
Well, you and I are very social for what it's worth. And, you know, the thing is, it's your point that in the suburbs, rents are very high in the biggest cities. So people have moved to the suburbs. And, you know, there have been some companies that set up offices there, but not everybody. Anyways, coming up next, we're going to look back at the market. There are a lot of events to watch throughout the week, and it is going to be a busy week despite being a short week. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Sonali Basak in New York. A quick look at what's ahead. Get you set up for your trading week. If today's your first week in the office, like it is for Sonali, welcome back, everyone. So we're going to get several eco releases between now and Friday. That's going to be including U.S. ISM services, China trade data, and German industrial production. Then on Wednesday, it's the Bank of Canada. Officials will meet on interest rates, and we're also going to be getting the Federal Reserve Beige Book, and we're going to hear from Fed speakers throughout the week. That will include New York Fed President John Williams, who will participate in a moderated discussion at the Bloomberg Market Forum on Thursday. Sonali, this one's really important. Williams doesn't speak a lot, and when he does, he's very influential. He's very influential at the Fed, so I'm looking forward to this one.
Yeah, so am I before that blackout period. We're going to look at stocks as well in pre-market trading in the United States. I wanted to show you what VinFast was doing because we're talking about new issuance, SPAC sentiment ahead of the ARM IPO. You are finally watching some cooling in VinFast. This is a SPAC that had taken this electric vehicle related company public and shot it up so fast that it had gotten a market cap that was worth more than Ford, Danny. You are watching some of that excitement start to seep out of the market after Labor Day. It is down more than 9% on the day today so far, pre-market.
Yeah, I mean, our Oliver Crook was just over at the Munich Auto Show. There was so much excitement about Chinese automakers, and especially if you're competing in a region like Southeast Asia, like Vietnam. I mean, when BYD is pricing things really cheaply, it's hard to see how you can compete.
I want to focus on another area of global competition. Let's look at the chip makers. Let's look at the semiconductor industry. Let's look at NVIDIA, because after a big really rise in the stock, we've seen so much excitement. We are watching a little cooling this morning amid some global competition. You're looking at the stock down 0.8% pre-market.
Yeah, here's the good news, though, from Goldman Sachs. Peter Oppenheimer Sonali says that AI isn't a bubble and the rally can continue.
I also want to focus here on Blackstone because you're watching S&P inclusion for the biggest asset manager in private markets. Remember, they're going to join prior to trading on September 18th. You're watching Blackstone stock up more than 4% pre-market on the inclusion.
Sonali, I'm going to be honest. I just have thoughts about your next stock. So get to it. You go.
Okay, I'll be quick about it. It's Man U. We all chose this. We added another stock for you. It's Manchester United. Shares are dropping because there is a lot of concern that this deal is uncertain and that the Glazer family, might take the club off the market, according to a report by the Mail on Sunday. So you're watching that down more than 9%.
Yeah, so heartbreaking. And I just want to say, I do live in London. I'm very close to being a British citizen. I do watch football. And Man U had a crushing defeat from Arsenal on Sunday. They had the lead 2-1. It was declared offside. Then Arsenal comes back in the last few minutes and puts 2 in the goal to win 3-1. That is my football TED Talk for the day. Thank you for coming.
You know, I am with you for the next 2 weeks. Maybe I start watching more football with you and we make this a daily thing.
I love this idea. I love it.
Well, that does it for us for early edition surveillance this morning. And surveillance is ahead with Tom, John, and Lisa. This is Bloomberg.
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
This economy has outperformed this year, both in terms of growth and bringing inflation down.
Inflation is going to come down faster, and that would allow the Fed to cut in 2024.
They've been able to slow employment, and they've been able to do it without significantly raising the unemployment rate.
The labor markets are normalizing. I think it'd be really unlikely that they're going to move at the next meeting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get back to work. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market negative by 0.2% on the S&P 500, following the biggest week of gains on the S&P going back to June. TK, the happy talk begins in September. Goldman cutting their recession chances to 15% after a week of pretty decent data to keep this Fed on the sidelines.
There's some interesting research over the weekend, the long weekend here in America, and certainly Goldman leads the way with that lesser recession call. What's interesting about it, John, it buttresses up against a China basically in policy chaos. And so to the global tone, I'm really unsure of where we go, other than Jerome Powell has a spirited leadership in economic growth right now.
Ben Laidler, eToro, it's as good as it gets. The bulls, Tom, still bullish.
Well, he's still bullish. It was a very nuanced note, actually. And Laidler says it is as good as it gets. And the nuance there, John, is that we peel away and maybe we get a lesser. And then he goes to a soft landing, which I still don't know what that means, but
yields down, tech stocks up.
Yeah, soft landing is when Bramwell comes back from her sabbatical.
Rainbows and unicorns.
Yeah, you know.
All good stuff.
She saw them on the slopes.
Bramwell returns less bearish from vacation. Is that how this works?
That's on that.
Can I just say, first of all, nobody's very that happy that the summer is over. Let's just be honest. I don't know if you guys have had those conversations with people. There's this feeling of just like, ugh, what are we heading
It's
toward?
not over.
It's, what, the summer?
Oh, it's in the 90s in New York City this week.
Are you wearing white?
I'm holding on to summer.
Are you going to wear white pants?
I don't wear white pants anyway.
Okay, that's a fair point. Anyway, I do want to say this. I think that probably this sums up my mood best. Diane Swank of Grant Thornton put it best. And she said, there are a lot of people who have decided an incredibly complex economy can be explained with half answers and a lot of armchair quarterbacking. She's confused, and she's
really
right. And it's basically a stew, and you have both sides hunkering down for what may happen at a time where we are on the precipice of understanding some of the rate hikes.
It's a stew. It may be a toxic brew, but we're doing it here in the heat. For all of you worldwide, we've really had a spectacular summer. And John, as you mentioned today, summer comes late here in New York. I did it to Celsius. I mean, it's summer, and, you know, it's 33 Celsius, which doesn't translate in early morning
It's
America.
going to be hot this week. in New York City. That's a beautiful thing.
Still summer.
It's not a beautiful thing.
The winter's an endurance. I don't want to wish
September's
away
terrible.
summer and embrace fall. I just
Ask Lagarde. September's terrible.
September 14th, big decision for them,
big
TK.
decision.
Big decision. They're stuck between a rock and a hard place. For the Federal Reserve, it was pretty clear. Coming into last week, the data needed to tell them why they needed to hike. It failed to do that, Tom. Based on every single job sprint we got basically last week, this is a Fed that's encouraged to stay on the sidelines unless you get a blowout CPI number on the 13th.
No, on the 13th is the CPI number, but to all of this, it's just the transatlantic disparity there, and it folds over into a stock market that's resilient. We started, this is like New Year's, John. I mean, in America, the day after Labor Day is just like January 3rd or that. It's a whole new year, and to start with Chivarone is going to be really constructive.
Looking forward to catching up with Steve around the table with us. Equity futures on the S&P, just to get you up to speed on the price action, just slightly negative on the S&P. We're down by 0.2%. Yields are higher by 4 basis points on a 10-year at 4.22. Yields aggressively lower on the front end through the last week or so, Lisa, off the back of that economic data in the United States.
Just amazing to see 20 basis points just plunging on the heels of some of that. This week is going to be a quiet one, but there are some interesting points that are coming up. Wednesday in particular, a big day today. At 10 a.m. we get ISM services data in the U.S. for the month of August. Very curious to see whether we see a rollover at all, whether we stay above the 50 mark, which is above recession, even as we see contraction over in Europe. We also get the Fed's Beige Book, and we're going to hear all about the effects of Beyonce and Taylor Swift and everything else, the Barbie movie, all of those things I expect to factor in quite significantly to the Beige Book. Throughout the week, tons of central banks speak. Who isn't speaking? ECB's Christine Lagarde speaking today, Bank of England's Andrew Bailey, Bank of Canada's Tiff Macklem. I mean, go on. And the Fed speakers, John Williams speaking at a Bloomberg Markets conference.
Auctions,
They're T-bills. They're T-bill auctions that are coming out today and throughout the week. But a lot of it will be interpreted in the price action of these central bankers. And then Thursday, this is sort of the most under-the-radar event of the week. And that is the striking action that could potentially happen around the world. We have what's going on in Detroit. That's next week. This week, Chevron's LNG export plants in Australia, workers there have threatened to stop work if they don't get a certain agreement. And this will affect certainly prices for China and some of the other Asian nations, but also in Europe. And I just wonder how much is this significant?
How does that affect Europe? This is Western Australia off Barrow Island, north of Perth. And how does LNG in Australia affect Europe? I don't get that.
There's a concern that it's going to create a pricing war because essentially you're reducing supply. And even though there are some well-stocked countries right now, later on, it could elevate prices. We've seen some price pops on the heels of this. Either way, again, it points to that stagflationary concern that people are experiencing with Europe.
The South rally in crude. I'm with Lisa. The energy market just not on the radar enough. We're talking about highs for the year.
Totally
in Brent
agree.
Yesterday.
Well,
Tom, getting closer and closer to the 90s, 88 right now.
We heavily covered this on Friday when both of you weren't here. 88.41 on Brent crude.
Well, we thought after you took half of August off that maybe we should get a long weekend. Steve Chevron, head of multi-asset solutions at Federated Hermes with us around the table. Steve, good to see you. I'll drop the mic and walk away. This rally, do you think it's got legs?
Yeah, well, I'd like to start by saying I'm going to hold on to my white pants and summer as long as the weather will allow me to, although it's not pleasant. No, look, I think the rally does have legs. You know, this argument over recession or not, right? Are we headed for a recession? It's kind of hanging like a sword of Damocles over folks, I think, in a lot of ways, and keeping people from being able to be tactical. And if you look at things from a Fed cycle perspective, you have a Fed that was hiking. They're either on pause or close to pause. Markets rip when Feds pause. In fact, each of the last times that the Fed has been on pause, you've seen an S&P hit a new all-time high. And I think that's the path of least resistance this time around. Now, and you pointed to the oil market a second ago. You know, you don't have energy prices rallying to year-to-date highs on the verge of rolling over in the economy. Now, that doesn't mean that rate hikes won't bite. It doesn't mean that the long and variable lags aren't there, but we're just not there yet, and I think the rally and the economic strength still has legs for the time being.
You add huge value in this thing called asset allocation, which I'm pretty suspect on. I think it's a great marketing tool, to be honest, but you really deliver. Go through the process right now of how you would reallocate a typical investor who's been in the market. Maybe they're up a little, but boy, they're not up like NVIDIA.
Yeah, I think the first thing that you do, and I think the biggest value we can add right now is keeping folks from getting seduced by 5% yields in cash. right? That's been a stalwart over the course of the last year. It's an attractive yield. But again, looking at those Fed pauses, on average, you'll see 10-year yields fall 0.75% to 1%. Hadn't happened yet. I wouldn't rush into that, but starting to lengthen duration. We think that's an important move right here. And then equity market returns again. We think we're in a period of time where inflation's moderating, growth is resilient. Could storm clouds form, 6, 9, 12 months away? Sure. But until you're at a point where you think the Fed is on the verge of cutting, and we think we're at least 9 months away from that, we think there's better returns to be had in both equities and bonds relative to cash.
How long can the U.S. economy and U.S. stock markets diverge from the rest of the world, where you see China slowing down with data overnight, you see Europe basically facing stagflation, and yeah, the U.S. keeps chugging along, but in isolation, is that really plausible?
Well, think about it this way from a market perspective, Lisa. When growth is most scarce, growth gets the best premium, all right? And if you're looking for growth, you're looking at the U.S. and you're looking at U.S. growth stocks, right? I mean, that are kind of producing their own growth. And what you've seen over the last decade, and I think you're seeing it again right now, is when economic growth is subdued, when the rest of the world is kind of softer, people flock for that growth. And where are you going to find it? You're going to find it in the U.S. Tech is 18.5% more of the there's 18.5% more tech in the S&P 500 than any other developed market index. That's where you have to go for growth, and I think that's why you see the valuations where they are right now.
And this is what's left me confused, others too. Growth hasn't been scarce in the United States. In fact, this rally's been built on upside surprises.
Yeah.
And now we're sitting here suggesting that when growth starts to disappoint, we can carry on rallying. Can you make sense of that for me?
Well, I think it's a matter of degree right now. And so what you've seen is growth has started to moderate in the U.S. You've seen the surprise index start to roll over. You've seen all of last week was a set of softer prints. But it's moderating at a pace now where no one's kind of spooked by it, if you will, right? It's kind of a soft moderation. It's allowing folks to at least believe for the time being that this is softening consistent with a return to some trend, a soft landing, if you will. That pace becomes more important. Bad news is good news when it's just a little bit bad. If it starts to deteriorate too quickly,
Just say it.
then the market
Goldilocks.
gets worried.
You want to call it Goldilocks?
No, I wouldn't call it Goldilocks. I would just say that it's moderating at a pace people are comfortable with. It's a tempering process as opposed to, an ice bath.
Are you pushing back then against the idea that for this rally to be sustainable, it has to broaden out?
No, I think it does broaden out. I think it does. I know I just talked about the kind of exception of U.S. growth, but I think what you'll see is that where we had weakness last year, the most severe weakness outside of tech was in some of the economically sensitive cyclicals, where valuations are not nearly as stretched. If you're really pricing out recession risk like Goldman did this morning, well, then there's energy stocks and materials and industrials and more cyclical areas of the market where I think you could get some revaluation higher. I think that's the next leg.
So in a second leg of a bull market, do you imply that we broaden out from the 7 or 8 stocks that have been wonder stocks?
Yeah, that's one of the, you talked about asset allocation. Within the equity market, that's our big bet. Our big bet is we are underweight large cap growth and overweight essentially everything else on the idea that you're going to broaden out here.
Okay, let's get Deborah Cunningham upset this morning. Where are you on 60-40? You said cash you don't like. Where are you on 60-40?
Well, I wouldn't say we don't like cash, but we're working down high cash levels. And I don't want to get in trouble with Deb Cunningham. But look, I think what you see is on the fixed income side, given some of the storm clouds, you don't want to be heroic. So you're starting to lengthen duration. We're underweight credit. On the equity side, this idea of broadening out. And then just slightly overweight equities. But again, we think if you're in a position where you're at 10, 15, 20% cash, you really need to start working that down. One, because there's better returns in equities, we think, in the short run. And if the storm clouds do materialize, you're going to want that traditional fixed income kind of bulwark.
Any of your clients starting to worry about nasty politics on the horizon in 2024?
Yeah, we're starting to get those questions. We do a kind of re-election dashboard, which looks at economic circumstances. Right now it looks good for the incumbent, but there's a lot of uncertainty. And then you throw in the idea that, you may have one of the party's nominees on trial the day before or after.
I do wonder whether we've really thought through how messy this could be. This could be
really messy. I mean, I think it's so far out that folks don't know how to price it in. So if you don't know how to price it in, you don't.
Come on, the Wall Street Journal poll released in the last 12 hours, I think.
I've got it on my screen right now, Tom. Brutal.
Brutal, but I mean, we've had these fractious times in American politics, but I think I can say maybe other than Alien Sedition, 1802, John, we have not had it more brutal, more uncertain. disparate. The polls are shockingly disparate.
73% of voters said they feel Biden is too old to seek a second term.
73. That's a big number, John.
Two-thirds of Democrats said Biden was too old to run again.
Well, and that's the possibility. The possibility is that we don't know the nominee of either party at this point, which adds another level of uncertainty here potentially. So this is going to be something, I think, as you get in the back half of this year, well, the last quarter of this year, as you will, and then the next year becomes a bigger issue. We'll say disparate. You've got totally different views on the markets. You have totally different views on how to run an economy, and a ton of candidate uncertainty. It could be fuzzy next year on the political front.
Fuzzy.
The
diplomatic way of putting
level
it.
4.
Steve Chevron of Federated Hermes. A rally that's got legs and a fuzzy 2024, Tom, just around the corner.
A fuzzy's uncertainty, and I really wonder what the bet is in the market. I think retail maybe's piled in. They're all up. They all own Apple to their eyeballs, but the bottom line is I can't get a handle on the gloom level right now. Part of it is Lisa was gone for 3 weeks, but I just can't get a handle on the worry in the equity market right now.
The data's cooling. It's just not up the Arctic or freezing cold. I think that's the way Steve put it. What did you say? Tempering.
Not Goldilocks.
It's 33 Celsius.
Not Goldilocks.
I have no idea what's up.
Don't use the G word. Kelly Kaminsky of Alpha Simplex coming up in about an hour on why Steve's still short this bond market. From New York City, good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
There are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union. Folks, in this Labor Day, let me tell you what we're celebrating. We're celebrating jobs, good-paying jobs, jobs you can raise a family on, union jobs.
President Biden at a Labor Day rally in Philadelphia over the long weekend. TK, this is how you have your cake and eat it too. You get to say you love unions at the same time union membership is so low it doesn't cause you a problem.
Oh, yeah.
That's the situation in America right now.
I mean, I don't have the numbers in front of me, but basically we've atomized the public, and particularly, John, we've atomized the union labor, I should say, away from public service. People that are working for the greater American bureaucracy are in unions. How many people outside it are in unions?
David Kelly at JP Morgan said it to you on Friday, Tom. going into the payrolls report, made the point of how much worse things would be in this economy if union membership was as high as it was back in the 70s. And this is what I mean, having it the best of both ways. You can go out on the campaign trails, say you love unions, all that good stuff, and at the same time, membership's so low, Tom. If membership was high, you'd have a very, very different problem as the President of the United States.
Then drag us over to Europe, which you've got your encyclopedic on, John. The answer is it's not like America over there, and that makes for a lot of rigidities within United Kingdom and continental Europe.
I would say same trends, though, Tom, over the last few decades.
Really?
In terms of union membership.
Atomization?
Similar trends.
Okay.
Similar trends.
Okay. Well, there it is, and we will begin today, and we do so the political. See, when's the next debate? I don't even know.
The 27th.
Nailed that. September?
Fox Business, I believe, yeah.
September 27th.
Yeah.
Same crew.
Hosted by Mr. Varney.
Same motley crew.
Stuart Varney hosting that one, Tom.
That's good.
Moderating. Yeah,
Well,
very cool.
Stuart will kill it. He'll be complete on it. We're going to be complete right now with Wendy Schiller, director of the Taubman Center of American Politics and Policy at Brown. Truly one of our most popular guests. We get huge response when she's on. Wendy, let's go to the images that we saw on radio. It was the president doing what he does, marching around with a mic, baseball cap on, hearkening to a union that he knew in eastern Pennsylvania long ago and far away. Don't they vote for Trump now?
Well, there's a lot of mixed voting in terms of unions, right? So if you think about the Teamsters, for example, they lean a little bit more Republican in their voting, but a lot of other private unions, particularly in the local level, vote for Democrats because they believe Democrats will spend money on things like infrastructure, which means construction, which means jobs for them. So it depends on the sort of local balance on where the jobs are in terms of private unions. You're absolutely right. About 7%, a little over 7% of the private sector is unionized, but public sector is still in the 30s in terms of unionization. And that can really matter in some of these key swing states. When Republicans go after unions, go after labor, they go after public employee unions, that can cost them votes. So Biden's sort of skirting the line, private labor, but also public labor unions are very important coming down to the election.
Politically, do you see a rekindling or rejuvenation of unions moving from that 7% statistic higher, or is that just wishful thinking on the part of union types?
Well, I think there seems to be a concerted strategic effort for unions to branch out. Things like college campuses, for example, unionizing undergraduates, unionizing graduate students. You may think, oh, well, that may not matter on the margins. However, that's a group that is still really ripe for picking in terms of votes. And it's certainly a group that the Democrats need more than the Republicans to get out the door. So every time you have a new union agreement or a new people coming into the union sphere, that's a pretty much guaranteed vote because unions are excellent still at getting out their base to vote.
Wendy, it seems like yesterday's speech did a number of things. It did highlight the union membership. It also highlighted the fact that there has been more union action recently. Without the strikes, that could potentially be a liability. But this is also what Biden said. We're turning things around because of you. When the last guy was here, you were shipping jobs to China. Now we're bringing jobs home from China. How much is President Biden trying to galvanize his campaign by going after former President Trump with the assumption that he will be the person he's facing off?
Well, Lisa, I would argue he hasn't done that enough yet. And also just to show Biden out on the trail, he can walk, he can talk, he's clear, he was energetic. I mean, given the most recent polling that has people really doubting his age and doubting his capability, the more he can get out and show that he's still vibrant, the more he can mitigate those kinds of concerns. So I think that's a really important part of this strategy. And also, if you think about some of the things in the most recent polling about Trump's job performance in office, it's relatively positive. So, the COVID after effect, which some people argue cost Trump the presidency in 2020, that seems to be diminishing for Trump. So, absent the indictments, there might be a rosier glow on how Trump's presidency went among average voters or independent voters. That's a real concern for the Democrats, a real concern for Biden. He's got to remind people of what that administration really was like and why they rejected it in 2020.
Does President Biden have any chance of winning if he's not facing off with the former President Trump?
Lisa, that is the Republican Party's existential question. You have to believe that the negatives associated with Trump, particularly among independent voters in swing states. And remember, some of these swing states have swung a little more to the Democrats in recent elections, at least at the gubernatorial level and the Senate level. And when you think about that, that's their issue. Would they do much better if Nikki Haley was the head of the ticket, or even Ron DeSantis, even if he looks shaky, or even Tim Scott? I'm not sure if Vivek Ramaswamy is the guy to go to, sort of Trump light, so I'm not sure that does it for them. But if they didn't have the liability of Trump, would they be doing and polling much more strongly among independents than they are now?
Professor Schiller, Jeff Stein with the article of the weekend on the nation's deficit, again, burgeoning out X number of trillion. Everett Dirksen and I have lost track of the billions and trillions. Is the debt of concern to an academic like you, or is it just the usual debt angst, not understanding the mass, the size, the scale of America?
Well, I think the parties have long abandoned really seriously worrying about the debt. The Republicans and the Democrats, all the Republicans use it. I think solving the debt limit crisis, I think that was, as we saw, something that both parties understood they had to finish and had to get done. But you'll see this rhetoric, Tom, absolutely in the next 4 weeks by the Republican Party. They're going to claim we spend too much money. They're going to want big cuts, and Biden's going to have to hold the line, which may lead to a government shutdown a couple of days after the second Republican Party debate. And that hurts in the end of the day. It hurts Biden in a lot of ways because he's the incumbent, and because the incumbent's supposed to run the government smoothly. If you couple that with another strike, another union strike, if we see the auto worker strike, I think that creates real uncertainty and concern among voters about the Biden administration. So it's a real risk for them.
Wendy Schiller of Brown University. Wendy, thank you for the latest on that Labor Day pitch from the President of the United States, Tom.
It's on unions as well, but buried in the Jeff Stein article in the Post, and there's been other articles on this, is the tax cuts of, I believe, 2017. I mean, maybe, I can't remember the Trump, they're identified as the Trump tax cuts. And there's a point here within the distractions of four legal proceedings and all that, where you're going to get a raging debate into 2024 on sustaining those tax cuts. That's not on the radar yet. It's going to be.
You mentioned the debate on September 27th. Any reason for the former president to show up to that, based on how he's doing in the polls?
It depends on his legal
and the bump
calendar.
The bump that he got in the polls after the last debate.
Maybe
that he
you should
didn't
stay
attend.
away. Maybe it's good.
I think a lot of people feel the same way about that, Bramo.
Well, and this is sort of the question about him. What happens when he starts to campaign a little bit more aggressively rather than just being the de facto front runner? Does he have to? And I keep going back to, given that Wall Street Journal poll that you mentioned, with President Biden and the lack of popularity and concerns about his age, what his chances of re-election would be if anyone other than the former President Trump was going against him.
I think that's the man he wants, TK. Overwhelmingly, that's the consensus view that that's the man he wants to face.
Oh, yeah. Absolutely. And I think this weekend, I mean, the distraction of the First Lady with COVID, in that I was sort of thunderstruck by the rekindling on a sleepy Labor Day weekend of a president who's 80. This is sort of the weekend where 8-0 came into the zeitgeist.
I think last week as well, after Senator McConnell, Tom, and the events with Senator Feinstein as well.
Absolutely.
All of this kind of building.
Absolutely.
Okay, coming up, Simon French of Penn Mill Gordon. We're going to look at the economy. Good. Plenty of economic data in the labour market over the last week, painting a picture of maybe a soft landing and a Fed that doesn't have to hike on September 20th.
We got through the first half hour here. Bramel's like, she's gone for 3 weeks, and she's like, bingo, she's right back in it.
Getting bearish.
Yeah, she's bearish.
Already.
It's a toxic move.
Fairly tame stuff.
Dusted off the Bramo cam.
Give her a chance, Tom. Fairly tame the first 20 minutes or so. Equity futures on the S&P trying to recover, negative here by 0.1%. From New York, this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
We've all been there. You get invited to go to Kyrgyzstan, where you're turned into a YouTube kids show star. Build a satellite and play a game with a goat. The point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
2 weeks of gains on the S&P 500. Let's see if we can make it week 3. Your equity market on the S&P. Equity futures slightly negative by 0.1%. On the Nasdaq, down by 0.2. Closing out August, opening up September. August, how tame is this? A monthly loss of 1.77% on the S&P. On the Nasdaq, 1.62%. First monthly loss going back to February, but Tom, really tame stuff, considering what that looked like halfway through the month.
Hugely tame summer. I did the sell in May and go away statistic here, and it's real simple. Sell in May, you're up 8% with that August recovery that got that tame August that we had, 20-some% annualized. I mean, sell in May and go away didn't work out this year.
Let's turn to the bond market. 2-year, 10-year, 30-year. 10-year, high of the month, high of the year, 436. All the way back down to the 420s at the moment, 421.82, yield high by 4 basis points. 4 monthly gains, 4 months of gains on a 10-year yield. The 2-year yield last week, though, Tom, 20 basis point move lower on a 2-year, 4.9%. Yields this morning high by 2 or 3 basis points.
And I'm going to look at the real yield, sort of center tendency, or 1.92. We haven't even talked about foreign exchange, which is fascinating this morning, starting with the yen. But the 10-year real yield is what the adults are looking at. And the answer is, yeah, it's midway, but it's really buttressed up near 2%, 1.92% right now. And to have that breakthrough, as Ian Lingen framed out for us last week while Lisa was away, would really be something.
Screaming buy. BMO, 10-year, screaming buy.
10-year, you know, there's some heated, people are placing their bets, John, is what I would say for September. I mean, they're really, it's like sort of like January 1. They're like really setting up.
Let's go.
Mike Wilson, we believe, that kind of thing.
We believe.
Yeah.
That stocks can't rally from here.
Yeah.
Seems to be the belief over at Morgan Stanley. Want to finish in the FX market. Tom mentioned some currencies elsewhere. Let's just finish with the euro. The euro at the moment, trying to hold on to 107.47, negative by about 0.5% here. Jordan Rochester of Nomura raised the possibility of this a couple of weeks ago, threw in the towel on his call for a move of 115, maybe pushing out to 120 through the next 12 months, and having a little look at maybe 105 on a euro against the dollar.
To triangulate, the tea leaf here for me, and this is for Christine Lagarde as well, is Euro Swissy. And it's really not like, OMG, Swiss franc strong, SMB's going to intervene. Forget about that. But John, 1, 2, 3, 4 days in a row of ever so slight strong Swiss franc versus euro is an indicator of the European tension.
107.47. Under surveillance this morning, President Joe Biden contrasting policies with former President Donald Trump in a Labor Day pitch to union workers in Pennsylvania. Here's the quote. Lisa, when the last guy was here, he looked at the world from Park Avenue. I look at it from Scranton, Pennsylvania.
What's interesting to me is that Scranton, Pennsylvania was an area that could tilt to former President Trump, and that you saw union membership actually tilt more to the populist rhetoric of the former president. Also interesting to me, how much is Biden hoping that Trump is his counterparty, right? How much is that really sort of the predication of his entire run? What happens if he isn't the front runner? What happens to the Biden presidency?
You know, who's running the shop for Biden? He's not on, Trump isn't on Park Avenue. He's on Fifth Avenue. I mean, he's on Fifth Avenue. I mean, that's identified.
I'm aware.
I take the Bentley down every morning.
There's plenty of quotes from this pitch that didn't really make a lot of sense, Tom. We're turning things around because of you. Lisa mentioned this one. When the last guy was here, you were shipping jobs to China. Now we're bringing jobs home from China. I remember when the former president was going off on his tirade about China, and people in Washington were calling him a lunatic. And now we're using the same language. Lisa.
Let's see what sticks. That's all I'm going to say. Let's see what sticks, especially with union members kind of on the fence whether they're going for Republican or Democrat. It used to be just a standby Democratic vote, and that has changed. And how much can President Biden really change that back is really going to be a key question for him.
Let's talk about China, the Chinese economy, with a private survey of China's services sector showing more weakness, expanding at the slowest rate this year in August. The services PMI fell to 51.8 last month, down from 54.1 in July. The hope is that the recent policy initiatives of the past week or so, Lisa, can turn this story around and turn it around pretty quickly.
So I've been reading a lot over the past week about how much the Chinese economy and the slowdown there is going to affect the U.S. and how much it's going to really transmit to Europe. Obviously, the transmission to Europe is much more direct. Brad Setzer over at CFR had a really good commentary on how they could really do this through the currency transmission. That if they let the UN really depreciate, that could really challenge some of the trade mechanism and increase trade to the U.S. much more than the Biden administration would like to see.
We really emphasized that last week, Lisa, and the idea here of yuan right now, renminbi is 7.30, and to see it pop through, and not to get back to 8.22, which is I think where it was in 2005 when they let it go to strengthen out. But the answer is sure, currency is the way to give way there. But their GDP isn't really all that bad. This is a balance sheet issue. This is a crisis of real estate, a crisis of garbage investment. And they got to figure out how to clear that market in an artificial system.
They had a major win last week. That was beautiful.
I was really working on it.
They had a major win last week, Tom, and barely talked about it. Hardly talked about it. Huawei. We've done the teardown. Our reporting here at Bloomberg suggesting that Huawei, along with China's top chip maker, have built a pretty advanced processor to power this thing and basically succeed even with these sanctions from the United States attempting to stop them from doing so.
Now, Bloomberg's been way out front on this off the Asian Pacific Rim watch. And John, you've been great on this for Bloomberg Television, but the answer is we're more concerned about what the Huawei chip than we are the new chip in the iPhone coming out whenever September Day. 2 of my family's iPhones broke this weekend. It's amazing.
How convenient.
It's amazing how that worked out.
Going into the middle of September.
Two.
But the effort there, Tom, I think is phenomenal. The fact that that dropped at the same time that the Commerce Secretary of the United States was visiting the country. All the talk, and we've said this a few times, ignore the talk, look at the action. And look at the action of the Chinese, Tom. To be able to unveil that quietly.
Well, and quietly,
phenomenal.
This G20 news of China and India, and frankly, America's involved in that as well. I mean,
but Tom, that's a perfect example of the way the West looks at the world. He might not turn up to the G20. Ooh. And at the same time, they're doing something pretty impressive with Huawei last week. That is far, far more important than whether the Chinese leader turns up to the G20. That's just our Western bias to the world, Tom. Who doesn't and who does turn up to the G20 as if that has real significant consequences.
I 100% agree.
When they're engineering those kind of changes on the ground in the mainland. I want to finish on this on Europe. ECB chief economist Philip Lane expecting core inflation to slow over the remainder of the year, telling Irish website The Currency inflation is standing at 5.3% overall, which remains high in terms of looking for signals of momentum and signals of directional change. I would underline the fact that there has been some easing in goods inflation and services inflation, which is a welcome development on the next decision for the ECB a couple of weeks away.
Important voice. Matt Bessler was on the couch in Jackson Hole. We were reading the first 3 or 4 paragraphs of the Lagarde speech, which got, a fair amount of play in terms of the speech and being at 60,000 feet. And Matt turns to me and goes, Philip Lane. And so this is an important voice. There's really no American equivalent to Philip Lane in that job that we've seen back to Duesenberg of being the lead economist. And ever more so, John, because Lagarde is not an economist.
And she's a consensus builder.
Yeah.
Clearly, we've seen that as well, Tom, develop. ECB, September 14th, next decision, Tom.
Let's get a brief on that right now and how it folds back into American markets and American economics. Simon French is chief economist at Panmure Gordon with really trenchant essays off the London desk of where we are transatlantic. How far apart is the American and European experiment right now, Simon?
there's big divergence now emerging, probably the largest divergence we've seen since the start of the rate hiking cycle. We've had 175 basis points of hikes from the ECB this calendar year, 100 basis points of hikes from the Fed, so you're immediately looking at a different pathway. But what that does, of course, because of the transmission mechanism, is it means that the ECB are flying into next week's meeting with much less data on what transmission has come through from the policy decisions they've made thus far into the real economy. And I like the fact that you picked up Philip Lane's quote there. The data that came out this morning from the Eurozone, the composite PMI report, slightly undermines that rhetoric, I have to say. It picked up a 3-month high in input cost inflation. And while he's right on a year-on-year basis, we're still in heavy deflation territory, down 7.6%. Actually, with crude oil picking up, with a bit of an inflection point in core wages in inflation, is that narrative a little bit stale? And therefore, Lagarde's job of as consensus builder becomes really hard going into next Thursday.
Well, the German word for this may be stopping, but I think it means pause. Is pause in the vocabulary of the hawks in Germany or the inflationistas in America?
I think pause is in the vocabulary. I mean, let's not lose sight that, okay, we haven't got consensus for next Thursday, but we still have the market 75% likelihood of a pause, thinking that, we've been here before, haven't we, with the ECB? We have the Germanic-led view, which is more hawkish on inflation, defeated round the table on the basis of data, and I think the latest PMI data more broadly in terms of output was pretty broad-based downside misses this morning, and I think that gives the pause rhetoric a stronger hand than it would have had, 24 hours ago.
One thing that John was just saying is that Christine Lagarde is a consensus builder, and she's trying to build consensus with a lot of different views on the ECB member governing council. I'm thinking of Isabel Schnabel over the weekend saying that recent developments point to growth prospects being weaker than foreseen in baseline scenarios, but underlying pressures remain stubbornly high, and said that they are being driven by domestic factors, not international ones, meaning it's going to be stickier. How much does she represent the core of the committee that wants to hike rates in favor of the risk of going too far than letting this get entrenched?
Well, I think Schnabel's speech, I read the speech as well, she's one of the, if not the most interesting thinker. But thinking good quality speeches did not necessarily translate through to building a consensus for driving the vote when the ECB Governing Council meet. And while I think she is correct, there is, if you took just the imported inflation component or the producer price component, it's consistent with, on a 12-month view, Eurozone headline inflation being negative. Now, I don't think anybody sees that, and therefore there is a decoupling of the historical relationship, and that goes back to what all the central banks were talking about at Jackson Hole in terms of the data tallying through to their models. But what Isabel Schnabel's talking about actually speaks to the degree to which there may not actually be much spare capacity given the ongoing strength of the Eurozone labour market, which is in complete contrast to the more cyclical activity indicators.
Do you think that that can be sustained? Do you think that there is a recession that is necessary, and a deep recession at that, to really wreck the labour market that you're seeing both in Europe and the US? Or do you think that it's just going to continue regardless because of structural changes?
I personally, I hate the phrase, the idea that an inflation is recession is necessary. I'm a labour market economist. I've seen the impact it has on productivity, on individual outcomes of people losing their jobs, and what that does to the long-term growth prospects of an economy, given all the structural challenges the Eurozone faces. The idea that there will be people around the ECB Governing Council table arguing that we need to have a relatively deep contraction in output in order to squeeze out core inflation. They may have one or two voices. The idea that they're the majority, I think, sits uncomfortably with me.
Are you acknowledging, Simon, that maybe they have a dual mandate they don't officially have?
Interesting.
I think most of the market has interpreted that, haven't they, Jonathan?
I think that's what's intriguing about this moment, Simon, because even the one with the dual mandate, there are questions about whether they would be juicing the inflation story by allowing the labour market to run hot. The trade-offs here, Simon, let's build on that just a little bit and take it over to the Federal Reserve. If that's a single mandate, central bank of the ECB, not allowing the labour market to crumble to get inflation back to target, why on earth would the Federal Reserve do anything like it with a dual mandate?
Yeah, and I think one of the reasons why, and bringing it back to the US equity market, one of the reasons why the second half of August was so strong, and we saw that inflection point, I think the 18th of August in global equities, was the idea that the Fed have got the message on that one. They have interpreted fully their dual mandate system, and actually the data is starting to support them. There's a series of data from JOLTS to payrolls, all suggesting a soft landing, and it's one I'm signed up to.
Interesting. Simon French, great comments as always. Of Panmure Gordon, thank you, sir. From New York City, futures slightly softer. Damien Sasser from Bloomberg on the latest data out of China. Coming up next.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The way I think about China right now is one word, and that word is traction. So when are all these little drips and drabs of policy going to actually, kind of do their thing, get traction, and move the economy forward? The consumer in China is not like hiding under a rock. They have plenty of room to consume. It is a confidence issue.
And they're trying to address that confidence issue. That was Jay Pulaski, principal and founder at TPW Advisory. Live from New York City. Good morning to you. Starting a shortened trading week. Your equity market right now just about negative on the S&P by 0.1% on the S&P 500. Trying to do something and build on the gains of the last couple of weeks, Tom, on the S&P.
That's not the lead line here. Jay Pulaski was on as a kid when he was a sophomore. He walked in front of 105,000 people at Michigan playing guard for the Duke Blue Devils. Yeah. Upset. Duke Blue Devils really crushed Clemson. Like John, 28-7.
Are we doing this for Paul Sweeney?
No, we're doing this for everybody. I mean, we're doing this for Jay Pulaski.
Did you watch it?
But it's like, no, I didn't watch it. I could give a damn. But I'm sorry. It's impressive. Duke Blue Devils. We're only doing this because Rubenstein's. There's a group of Duke.
He went to Duke as well.
Yeah, very Duke.
This is the Duke thing.
Yeah.
Just a nod to people who like Duke. What about people who like Michigan?
Michigan?
We
do
enjoying
Michigan
this
as
moment.
well.
Okay. Shall I complete the market check?
Yeah, do the market check.
Okay, thanks.
Please.
If you could just bring the board back up and we'll check out the
let's
bond
bring
market.
up the board here.
Yield's a little bit higher this morning by 4 basis points, 421.82. I thought you'd want to talk about Max and Formula One over the weekend.
Yeah, we can do that now. 10
consecutive wins, just dominance.
It was fun. I loved it, John, because it's a 101-year-old course. it's flat, like they really struggle going through the turns because of the lateral motion. But the best thing about this, folks, is it's bumpy. Like the cars are bumping around because it's like they're on roads. They're not on some smooth, perfect pavement like Miami.
Well, he makes it look easy, doesn't he?
Oh, does he? He went by the other guy, the guy in the red car.
Carlos Sainz, that
Yeah,
red car,
he
the
went
Ferrari.
guy with a red car. and folks, it's like, okay, you're out of the way. See ya.
See you later. Yeah,
You
I know.
mentioned this before. They ignore the number one guy for the
They
rest
just
of
start
the race.
focusing on everyone else. The battle between Ferraris.
I loved it. I loved it. I loved the whole thing about it.
Congratulations to Max and Team Red Bull, just absolute dominance.
Really, and thank you so much, Christian Horner and the rest, for giving us access to Mr. Verstappen. His incredibly busy day. Thanks for your response here to our. Let me rephrase this. Thank you for your response to John Farrow's smart interview with Max Verstappen. I added about 0 on that. Never adding 0 is Damian Sassar, Chief Emerging Markets Credit Strategist at Bloomberg, and also, of course, NCAA expert. We'll get to that here in a moment. Good morning. EM to me is sort of topsy-turvy, and I'm led by the emerging market Japan, where all of a sudden 3% inflation is like, and up goes the yen, weaker Japanese yen, not near 151 intervention, but that's the Pacific Rim tension this morning, isn't it?
Well, I mean, and that's not the only one we have to talk about inflation regarding, right? I mean, we had PPI print this factory deflation actually probably down 3% in China this week. We also get data on trade in China this week. So even though it's a shortened week here in the U.S., there's a lot of data to consume out of China, and no data point more relevant than what's going on in the property sector with Country Garden, who actually made payment on $22.5 million in coupons last week. They made payment on a ringgit bond. They extended a yuan-based note. They have $1 billion of yuan-based debt coming due between now and year end. So they need to, restructure some of that. We'll see if they're successful with it. But, people are looking at other property developers like Agile and Season and Sino Ocean and Vanke and all the debt that's maturing over the next month alone. People are getting they're getting a little frightened about it.
Damien, we'd like your opinion on how the policy shifts of the last week change the data in our future. Can you go through some of the big calls that they've made in the last couple of days?
The policy shifts. Are we talking about
around
central
mortgages?
Bank? Around mortgages. Okay, so basically, they did extend the down payment on first and second time home buying was lowered to 20 and 30% respectively, and it really doesn't impact much, right? Because most of the cities, the tier 2 and 3, I mean, they're already at those levels. So even Beijing, it doesn't really kind of move the needle so much. And when you talk about a Country Garden, which is predominantly in tier 2 and tier 3 cities across China, it's just not going to move the needle all that much, Jonathan. So I don't think the government's doing anything in the way to help things. We got some PMI data out also, which basically shows the economy going from bad to worse. So there you have it.
So, Damien, here's a question, right? What do they do if you have Xi Jinping, who seems morally opposed to stimulus in any kind of meaningful way, thinks it's welfare, thinks it's the Western way, wants to reject that? Is it basically to go to the currency, allow the yuan to depreciate, and then juice exports no matter to where, regardless of policies, because at the end of the day, price will win?
Well, that's what they've done in the past, right? So, I mean, if that's precedent, I don't believe they're going to do that again. They're not going to do any bazooka big bang stimulus yet, but that is certainly an upside risk to the economy. So when we talk about these trades in emerging markets where people really make their mint, I've mentioned Argentina. I wrote about Venezuela. They have a, bond that basically is backed by Citgo assets that rose 50% year to date. We talk about China high yield, and we talk about the China property sector. And I don't want to call it, it begins with an F, it ends with a U, and it's not fondue. But those types of trades, those ones when there's no fundamental justification for owning it, there's no structural reason, maybe there's some behavioral reason for owning it, but you look at Venezuela, you look at Argentina, you look at Turkey, you look at China high yield in the property sector, and maybe, you have to have a little bit of that on, especially if the rest of the world isn't going into recession, and there might be kind of a risk-on trade to be had there.
So are you basically saying that the risk of China falling into recession, or just the risks that are circulating around China, have been overblown and overtraded? Or are you saying...
No, they're all very justified, Lisa.
Okay,
what I'm saying, though, is the asset prices, because it doesn't take much to move the needle, as we saw in the first quarter this year. So it doesn't take much to move the needle. Again, no fundamental justification for it, but you just can't ignore it. It shouldn't be zero in your portfolios.
I got to go back to fondue. It's not fondue. That's the tension that's out there right now. Discuss further the fondue of the moment.
Tom, look, fondue, you're really going to push this one. I mean, look, I got in trouble the last time I was on here because, I was speaking a little bit loosely, freely. Amy slapped me around. So, no, look, seriously, though, I really believe that, China is going from bad to worse. But again, 0% in your portfolios might not be the right positioning. So look, that's all I have to say about it. I'd love to talk about Scuderia. I was really looking forward to Carlos Sainz, really, and it was, he had 14 laps, and then it was bye-bye.
You couldn't hold him back. Couldn't hold him back. It's just too quick.
What is DRS?
Drag reduction system.
That's like turbo?
Rear wing opens up. Yeah. Less drag.
Do they all have that?
They have that option, and you can use it only at certain parts of the track and only if you are within 1 second.
And some people do it much better than others. Am I right on that?
So the DRS system at Red Bull is much, much better than the DRS system elsewhere, just in terms of the additional speed that you can gain from opening up that little flap in the rear wing, Tom. Okay, was that enough for you?
That was good. I did not watch it.
It's like bumpy.
Oh,
they're bumping around like
porpoising. We like to call that porpoising, I believe. Is that not? Oh, porpoising's when the car kind of bumps in and hits.
When you're bouncing up, yeah.
Yeah. No, I mean, but look, Lewis Hamilton, they need to put him in a proper vehicle. I mean,
he needs a Red Bull.
He needs a Red Bull.
I think we all need a Red Bull.
He just resigned. I know that.
I wanted to squeeze this in just before you go. This is the question I wanted to ask, and it's not about Formula One. Should we care that the Chinese leader is not going to the G20?
I think you should, yeah.
Why do you think we should?
Well, because you want to have dialogue there. You want to kind of have transparency there. You want to see that, people are kind of looking to play nice, even though the sand pit is a little bit sandy. But I think at the end of the day, it's going to be interesting to see how, the U.S., again, we're moving into a multipolar world, where countries have to pick a side between the U.S. and China. And the question is, those that can maintain that middle ground of neutrality, should they be afforded a premium? I'm thinking India, I'm thinking Brazil.
Interesting. Where does Europe fit in with that?
Well, yeah, they have to pick a side, certainly. And quite frankly, their economies are much more directly tied to that of China. So we'll see which European country. You see what's going on in Italy. So, they're kind of pivoting away from China, which is interesting to see.
Yeah.
College football, Deion Sanders, the Buffs. I was stopped on the street literally. Me and Vet Bill were out for a stroll in the 33 degrees Celsius heat. And a Buff stopped me on the street. Explain to our international audience how a stud like Deion becomes a college football coach and stuns Texas Christian University this weekend.
So my microphone fell out of my ear, so Amy, if I go over on this, please just, have somebody smack me around. But the reality is TCU is number 19 in the country. They almost made the top 4 last year. They almost made it to college football finals.
They're like a real program.
And Deion Sanders is taking advantage of new NIL laws, the ability that players can move freely and not have to sit out a year. And he's bringing in some of the best talent to Colorado, the Buffaloes. And he brought his son over, who had, I believe, 500 or something all-purpose yards. He was outstanding. And it's all about primetime Deion Sanders, Hall of Fame cornerback, former Dallas Cowboy, San Francisco 49.
You couldn't get into the sink afterwards.
Do you want me to say something back?
That's the most famous bar in America.
Okay.
That's where you graduate. You drink Coors 3-2 beer, and one day you don't. At the sink.
Okay. Damien, thank you.
You used to go to Talagi's, but that's shut down, so you go to the sink.
Are there any bars at these colleges that you haven't had a drink at?
No, although Ohio State is really difficult because you go down the road there, and there's like 14 bars in a row. You don't even know which one to go in.
You've done that too.
I've done that too. Me and Rachel.
I really believe you, but I believe you there.
She led the way. She knows the bars.
Katie Kaminsky, up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that
matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority. Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This economy has outperformed this year, both in terms of growth and bringing inflation down.
Inflation is going to come down faster, and that would allow the Fed to cut in 2024.
They've been able to slow employment, and they've been able to do it without significantly raising the unemployment rate.
The labor markets are normalizing. I think it'd be really unlikely that they're going to move at the next meeting.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is not the September people forecasted about 9 months ago. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500 trying to recover, down by almost 0.1% on the S&P right now. TK, things are better, far better than we thought they would be 9 months ago.
Yeah, some would call this New Year's for the business community here, back from the summer, kids back to school today, tomorrow, the next day, whatever. I mean, it's sort of like an important moment forward. And as you say, they didn't get September 9 months ago. I didn't think they got September or August 5 weeks ago. It has been a topsy-turvy end of summer. Why should September be any different?
Goldman Sachs, recession, 15%. Yeah. Can we get the quote up from Jan Hatzius? Reads as follows. First, real disposable income looks set to re-accelerate in 2024. Goes on to say on the back of continued solid job growth and rising real wages. Second, we strongly disagree. Lisa, I know you've got a view on this one, with the notion that a growing drag from the long and variable lags of monetary policy will push the economy towards recession.
That was the exact same quote that I had highlighted when I read this. And the part of the reason why is because he's basically pushing back against everyone who says that we will see a natural slowdown in growth, which raises two questions. Number one, how bullish do people need to get? You've got Goldman Sachs coming out and saying that tech needs to also rally, that AI is not underpriced, et cetera, all around bullish. And number two, does the Fed have to do more to curtail some of the growth and the strength and, frankly, the ongoing and stickiness in inflation?
Heart of the matter, Bloomberg Financial Conditions Index still very accommodative, a positive 0.36, nowhere near the negative restrictive number Chairman Powell needs. But, you know, I just going to say here, the bulls aren't getting enough love, and they did not get enough love over the long weekends. Nobody's talking about Stolfus. Nobody's talking about Bikram Chadha. Nobody's talking about Yardeni and Kampora. Sell in May and go away. Bring it up on radio. I got the numbers here for TV. Let's give it out to radio across the state. Sell in May, John. May 1st. SPX up 8%, annualized up 26%. That worked out.
Year to date, double-digit gains.
Yeah.
I think the Bulls have had some love this year, Tom, don't you?
I think the modern internet, digital media has a gloom bias.
That I agree with. Of course, the clickbait on the perma-bear side of things.
It's just
I totally
there
understand.
on Fridays. It's
totally
usually
understand.
out of control.
Can I just say, anecdotally, the pushback to the perma bears has been
quiet. We need
increasing
this.
and incredibly.
Kaylee Lines John
No, but it's
failed at
interesting.
this.
There are many people saying you got it wrong just to concede, and a lot of the bears aren't conceding, even though they're coming under a lot of heat. I will say that they're not getting love.
Just anecdotally.
Anecdotally.
Of course. Okay.
Anecdotally.
Futures on the S&P.
Did you
look
dust
like
off
this.
the lens to the Bramwell camp?
She's ready to go. 1
Obviously.
week's rest. Futures on the S&P, negative here by 0.2%. 2 weeks of gains on the S&P 500. Best weekly gain going back to the middle of June for both the S&P and the Nasdaq. In the bond market, yields lower at the front end through last week, aggressively lower on a 10-year right now. Yields a little bit higher by 4 basis points. Lisa, your 10-year, 422.42.
It's a quiet week to start the new year in terms of just post-Labor Day work week. Wednesday really is going to be key. We get the Fed's beige book. I am very interested to see the influence of Barbie and Oppenheimer and Beyonce and Taylor Swift, which I think a lot of people are also looking at, not joking. We also get ISM services data at 10 a.m. for the month of August. And do we have a similar kind of feel that we saw in Europe overnight in the sense that, you know, there is this cooling that could even cool into sub-50 reads. Throughout the week, who isn't speaking from a central bank across the world? ECB's Christine Lagarde, Bank of England's Andrew Bailey, and John Williams of the New York Fed are the ones that I'm watching. How much they guide towards some sort of balance of risks in terms of weighing both the potential damage to the labor market versus really curtailing inflation. And Thursday, we are focused on all of the union activity. And John, I feel like we have to really keep focusing on what this could mean longer term. There are unions at 2 of Chevron's LNG export plants in Australia that have threatened to stop working on Thursday if they don't get certain concessions. Unclear what this means for European natural gas in the short term. In the long run, there is some risk there. But this just is one of many of the same kinds of anecdotes of increasing union activity, whether it's the UAW or whether it's in Australia. Got to keep an eye on it.
We'll catch up with AMH on some of that union action stateside in about 10 minutes. Just a word on the beige book. Patrick Harker of the Philadelphia Fed sat down with us in Jackson Hole, talked about things anecdotally, Tom. Just some examples of what he's hearing in his district, in his region. I think this is really, really important. The beige book finally, and I asked him the question directly, you telling me that maybe the beige book from the Federal Reserve might be more important than some of the hard data? The Dallas Fed manufacturing, if you look at some of the commentary there, Tom, from businesses, ain't good. Not pretty. I wonder how much of that shows up later this week.
And it matters in Philadelphia. You got 2 things going on. The character of the small business. I don't mean like 12 employees. I mean like 1,200 employees. The character of small business within the Philadelphia Fed. And also Harker not only is a Wharton guy, but somebody really steeped in the business pulse. That makes for an important comment from him.
It's my best effort at selling the beige book at 2 p.m.
That was
Eastern
very
time.
good.
Thanks.
It made it very interesting.
Thanks a lot. Katie Kaminsky, Chief Research Strategist at Alpha Simplex, joins us now. Katie, short question just to open up. Are you still short the Treasury market?
Yes.
436 didn't get it done for
Come
you.
on. First time guest.
Hey, it
you
was a
gotta go
short
longer,
question.
Katie.
No. There is a follow-up. It's okay.
Please,
we
follow
welcome short answers. Katie, let's elaborate on that. We saw 436 on a 10-year. We got back to 5.1% on a 2-year. What exactly are you looking for? Why is the juice worth the squeeze?
Well, I love that you asked this because everyone keeps saying, let's be bullish, the bond market, but look at the price. Look at the price all summer. It has continued to go up in yield. So yields, even though they pulled back last week, they continued on Friday and they're continuing today. And what we're seeing is we need to see a flatter yield curve. And everyone's really ready for there to be a pause. And there's probably a pause, but I think it's going to take a while before we see a flatter yield curve and before we see a situation where inflation has come down. Thus, we're going to see higher yields for a little bit longer.
What does it mean to be bearish at a time where yields are jumping all over the place? Are you outright short or are you just not buying the stuff?
So in the futures markets, the technical signals have been outright short for 2 years. And that sounds interesting, but it really means that they're, in some sense, in contrast to what you would think about most fundamental traders have been thinking about the bond market. But we've started to see a lot of fundamental traders as well saying that they're also short the bond market, which means that they're shorting bonds, expecting that we're going to need to see a flatter yield curve, that we're going to need to see a higher yield return on longer term debt, And this makes sense because maybe we need a duration premium back in the curve for the short term.
When people ask you for some sort of fundamental explanation for why longer-term bond yields will remain high, pointing to the idea that we're probably going to go back to some sort of normal that we saw pre-pandemic of slow growth and slow inflation, what do you say? Is it just technical? Is it foreign buying? Is it something about just the debt load of this nation?
That's a really good question. I mean, I think it's a combination of either a preference for holding that long-term debt, either as a hedge for potential deterioration in financial conditions, a view that we could have rate cuts faster than they might occur, is the two common ones I'm thinking about. So a lot of people are thinking, well, hey, things look good, the Fed's going to come in and cut. But my concern is that they think that, but now it's looking like it was originally going to be 2023. Now they're saying 2024. Who knows when it's going to be 2025? My view is that we're going to take time to get to that point with the Fed, and thus interest rates have to stay higher for longer. And if you're going to hold a long-term bond, you need to have that duration premium over the shorter-term return of holding shorter-term debt. So in that sense, it's a fundamental view in that sense.
Katie, that might be an argument for why yields should stay high. What's the argument for why they will be higher?
So why they will be higher is that I think that it's not priced in that it could take longer to get to cuts. And so people are assuming that, you know, things are going to go back to normal and thus shorter term rates will go down and we'll have a healthier curve. But if in fact they have to stay higher for longer in the short end, that means that longer term rates have to go up. And it's a simple question when people start to realize, wait a minute, I'm getting 5-something% for 2 years. If I'm going to hold something for 10, maybe I want a little bit more.
Catherine, let's talk trending. Let's talk Katie on the great giant Wells Wilder. If I look at Brent crude, I have a nascent uptrend like I had 3-4 years ago as well. On ADX DMI, on parabolic SAR, on exponential Kleinman moving averages, is Brent crude trending higher?
Yes. And that's the biggest thing we've been focusing on. So if we want to connect this inflation story, the thing we're watching is the oil market, because we're looking for catalysts, something that might give us another wave of uptick for upside risk in the inflation numbers. Those are the things that are going to cause the Fed to be more cautious. And also we're seeing signs of that outside the US. Of course, we saw some, yeah, exactly.
Katie, come on. It's the beginning of the year, the beginning of the business year. What's your point figure target on Brent crude right now? Over 100?
I don't have the exact number, but we're definitely seeing that's one of the biggest growing trends in terms of our signals. The signal strength for Brent crude has been one that's been ticking up lately. It did revert a little bit in August based on some data on China and other, the dollar also weakening a little bit. So we started to see some dollar strength, dollar weakening messing with some of that trend. But in general, that has been the trend to watch more recently. And the reason that is important is because that is one of the indicators, at least when we've seen inflation data down the pipeline. Brent crude has been one, for example, in 2022, that tends to be something to follow as a catalyst into where you start to see inflation numbers tick up later in the year.
Katie, thank you for the update. Katie Kaminsky there. Alpha Simplex on a bond market and a crude at the end there as well.
Didn't give a price.
5-day rally on Brent coming into today. A bit softer this morning, 88.35 on Brent crude. Does it matter if it's a demand side rally or a rally led by the supply side, Tom? Because arguably over the last week, this has been a story about tighter exports and output coming from Russia and potentially from Saudi down the road.
I'll let the oil pros answer that, including Will Kennedy and our great team at Bloomberg. But the answer to me is on the supply and demand nexus, if you get it post-pandemic, it's just another indication that we're beyond COVID.
Are we beyond COVID? I hope we're beyond COVID.
Well, if oil pops out on a better Pacific Rim demand, that's what you get.
Wear a mask.
I was going to wear a mask for the set.
Don't
just to
wind
see
me
what
up.
would happen.
Okay. If you're just tuning in, welcome to the program. The S&P 500 negative here by 8.2%. Is that where things are going, Bramo, later this year?
I think there's enough pushback that maybe not.
Go on, you want to be super bearish?
Yeah, well, no, I don't
That's
think
a
that's the
softball,
case.
isn't it?
Hold on a second. No, that's not that we think that it's going to stop the world. But sure, people are getting sick from COVID again. And we're not just talking about Joe Biden's wife. I mean, I have friends.
The First Lady, Lisa.
Yeah, okay. It's the First Lady. It's not just the First Lady. Seriously? What is this? But it's also, I've got friends and relatives. Everyone's getting COVID
I
again.
decided this weekend when the
Joe
booster
Biden's
comes
wife
out,
sounds like the lady down the road, around the corner.
Isn't that what he wants? Carry on.
I decided this weekend, John, when the booster comes out, I will get it. I hope it's the Pfizer booster, which is what I took before. But I predict there will be a massive political and cultural debate over boosters. And I'm going to listen to the pros like we talked to at Johns Hopkins.
Okay. We'll get Johns Hopkins back on. We'll catch up with them about this, yeah.
What, every day?
No, not every day. I don't want to go back to that. Not every day.
It's not
We're
like
doing
that
every
now.
day.
COVID's not like that.
Because we've been exposed to it, so you're not going to have the same kind of mass hospitalizations. That would be terrible, and nobody wants
I think there's a lot of bad science going on right now. I take real issue with it.
What's the bad science you don't
The
like?
bad science here is not understanding the purpose and outcome of boosters and vaccines. They protect you if you get it, as the First Lady.
Okay.
Thank you.
That's
Your
enough.
end of
That's
the
enough
rant.
COVID for this week.
Hey, look what Bramo does to us.
You're going to blame me for this?
Kaylee's all sunshine and flowers. We are the world.
Bramo's all masks and COVID.
Yeah, all gonna die.
Aren't you glad that I came back?
Yeah, we're
so glad.
I could tell.
Willie Caesar.
We were gone for
Credit
3
Suisse.
weeks.
Joy.
Coming up a little bit later. AMH up next in DC. City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
Is
story.
there the kind of upside?
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control, Alt, Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
When the last guy was here, you were shipping jobs to China. Now we're bringing jobs home from China. When the last guy was here, your pensions were at risk. We helped save millions of pensions with your help. When the last guy was here, he looked at the world from Park Avenue. I look at it from Scranton, Pennsylvania. Wall Street didn't build America. The middle class built America, and unions built the middle class.
President Biden at a Labor Day rally over in Philadelphia over the weekend, Tom, making the point that he's your man for the unions going into the election next year.
That is core Joe Biden. That is a religion from a long time ago, John. I'm not sure how it plays today.
After decades in Washington, I'm still the man from Scranton, Pennsylvania.
Wheelhouse Joe Biden, comfort level off the chart. And I just wonder, I thought that Professor Schiller from Brown was brilliant on 7% unionized in America. That doesn't get you elected.
That's why you get the best of both worlds, Tom. You get to say, I'm a union guy. And at the same time, unions don't cause you many problems because union membership is so low.
Yeah, I think that, but there's a trend. I mean,
all of that stuff.
You know, I think, John, you helping out here, and that it sort of crept up on us through this summer, and all of a sudden it's there. And, you know, Liam Denning, writing for Bloomberg today, is just scathing about the moment we're in coming up in 1 week.
What did he say about the unions, about UAW?
Well, this is really
Detroit
important,
3.
and it gets us into Anne-Marie here. He calls it pricing, payrolls, and payback. The payback is the political part of it.
Oh, the payback feature of it, yeah.
Same with UPS, the Teamsters.
This is a decade, in their minds, arguing, Lisa, that they've been underpaid for the best part of a decade, and we've reflected on this a million times in this program. Everybody has had those annual evaluations over pay and have been told, not this year, inflation's too low. And now this is this moment for some of these unions to say, well, the time's right now.
And I would argue they're getting the wage increases. They're not striking. And President Biden, I would argue, is getting a pass because he can have pro-union rhetoric without the strikes to accompany it that do shut down business and do potentially gunk up some of the infrastructure and the supply chains.
If you had union membership now in line with the membership we had back in the 70s, the pass-through from inflation into wages would have been brutally high. And we've had a very, very different situation. So the soft landing that the president is hoping for into 2024 arguably would never have materialized if we had the kind of union membership, Tom, we had back in the 70s.
Yeah, I'll go with that. And I'll go with the disparity of UAW between traditional UAW workers and the whole burgeoning EV market. They're trying to set up a two-tier labor structure. That sounds familiar with the airlines of years ago. And, you know, that's where we end up, is this being a major theme. When did you say, John, September 27 is the next presidential
Yeah, that's the debate. That's the debate.
It's got to be. Can you imagine that debate with UAW on strike? Whole different debate, to say the least. Briefing us this morning, Anne-Marie Horton, Bloomberg UAW correspondent, joining from Washington, is, well, you know, you brought to me Liam Denning's wonderful column. I'll get it out on Twitter, folks. And he talks about pricing, payrolls, and payback. Payback, Anne-Marie, is your territory. Who's paying back whom?
Well, workers really feel like they have leverage at this moment. They also feel like they have been left behind. They were there taking pay cuts when there was, of course, the potential shutdowns of all these big auto companies and the bailout. They wanted to make sure that those auto companies were going to remain in America and that they could continue working there. So they took pay cuts. You also had, over the course of the COVID pandemic, a lot of people in the private sector being able to work from home. And then you had this quiet quitting, everyone feeling like they could go out and extract more from big companies in terms of pay and leverage on how they want to have also work-life balance. And now what you see for these workers that they feel like for years they have not gotten a fair deal. They also feel like they were there during the tough times of the pandemic. So they are not just asking for a more than 40% pay increase. They also want a much less working week. So that's what you see right now when it comes to payback. It was interesting to hear the president speak yesterday, though, when he was asked by reporters on the sidelines if he thought there would be a strike, and he said he didn't think so. And Sean Fain, the UAW president, came out and said, well, he must have different information than I have, unless these companies plan on
what's he supposed to say?
Night before.
Yes, there'll be a strike. You know.
Well, no, and their intent is not. Well, he could say that he's concerned. You know, there is consternation in the West Wing about a potential strike.
Okay,
so
but
that's what the fact
let's
is.
conflate two stories here in Washington this morning. We're off the record, the Hay Adams Bar, you know, your corner of the bar where you hold court about 5:30, 4 days a week. You and I roll out of the off the record, and right up the street is the UAW headquarters. Meanwhile, Joe Manchin is really threatened in re-election. How does someone like Joe Manchin or Sinema, I believe an independent of Arizona, or even Bernie Sanders up in Vermont in re-election, how do they deal with the burgeoning union movement?
Well, I think you have to go back to John's point. yes, there is potential that we're going to see a strike from UAW. There's also potential that there could be a strike from the American Airlines flight attendants. We still have on strike the writers union, but it is not impacting the overall economy just yet. So right now, I think it is way too soon. What those senators you just mentioned, what is front in mind for them is that they are back today, is that they need to figure out how they're going to keep the government open past September 30th. For the White House, this is a huge issue because the president continues to want to have events like he had yesterday, saying that he is the most pro-labor union president in modern history.
So going forward, we're going to talk more about this deadline, the potential for a government shutdown. But on a broader level, when it comes to the whole union push by Biden, there is an issue, an angst in the Democratic Party that they have lost the Rust Belt. They have lost the working class voter. How much are they winning it back with this type of rhetoric and argument?
Well, it's difficult because this administration is also pushing forward a climate industrial policy. And that's what Liam Denning's piece gets to today. And he said it's more about the political will and economic will of this industrial policy. It's not just climate change provisions. This is the biggest industrial policy we've seen from the U.S. government since the end of World War II. And at the heart of that is electric